That would be the longest streak for both of those indices going all the way back to May of 2022. So we're talking about like one of the worst streaks in almost 3 years, if that indeed happens at the end of the day.
Yeah, I mean, we've just seen certainly, stocks struggle. We're at the tail end of earnings, although we've got a couple of earnings that certainly were key in today's trade and a couple of big ones that we continue to get to fill in the earnings picture. But this is so important, and we're getting stories of concerns about, or I should say, the C-suite talking about uncertainty, economic uncertainty in terms of the outlook, pointing to things like trade, sentiment. These are things that, especially sentiment, it's just a way people feel, whether it's about shopping, spending, or what they feel about the market. But sentiment can turn into reality. And so that's why we pay so close attention to it, especially when we think about what might happen. I mean, we're almost halfway through this year. I know we still have a couple of months.
What?
But I know.
No.
But it's kind of moving.
Let's say we're almost a quarter of the way through this year. Let's say that.
All right, a quarter. A quarter
Okay.
technically
Right.
correct, but it feels like a lot more.
It does feel like a lot. Look, I talked to some market observers this week who repeated this idea that once we do get regulatory clarity on tariffs, which supposedly is coming April 2nd, the president keeps reminding us, then we will see things settle down a bit. I don't know, Carol. I'm not so sure.
I got to say, if that's it, yes. If more tariffs possibly come, or we continue to hear it in the narrative out of the White House, that could be problematic. Hey, listen, another great bellwether, economic bellwether, market bellwether is FedEx. We got their earnings last night. Stock at its lows today, down almost 12%. Right now, down about 6.3%. Company did lower its full-year guidance for a third consecutive quarter, citing inflation and citing uncertain demand for shipments. So let's get back to Lee Klaskow. He was with us as we were breaking down those earnings last night. He's Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. He joins us from BI headquarters in Princeton, New Jersey. So, Lee, did we get more from the company following earnings about that cut in its full-year guidance for the third quarter?
Yeah, I think what it pointed to is a weaker industrial economy and a weaker B2B demand or business-to-business demand. So obviously not the home deliveries, it's just parcels between companies. So think of lawyers and things of that nature. That's been much weaker than I think they expected. And as you mentioned, we're mentioning, the whole uncertainty that's swirling around the economy really is making it hard, not only for people like me to kind of figure out, where things are heading, but also the C-suite to kind of give guidance that's going to come in within range. So there's a lot of risk to guidance going forward for not only FedEx but for a lot of companies in the space, because if the risk or if actual tariffs are going to hurt demand and be inflationary, that is going to really hurt the freight economy recovery, which is something we were really hoping for in 2025, but it seems that recovery is getting pushed out further and further.
Lee, how much further do you think that recovery is getting pushed out?
Well, we're seeing certain aspects of the market. So like the rail industry. The rail industry is showing volume growth, which is good, but some might argue a lot of that growth is just pull forward demand. Less than truckload carriers, which FedEx is actually the largest provider of that kind of service, LTL service in their FedEx Freight business. That's been down. We've seen tonnage down from FedEx and from its competitors down by mid to high single digits, and that business is really tied to the industrial economy. So that business will go as the ISM goes, which is a good leading indicator. And while that's been positive for the last 2 months, it's been barely in expansion mode. So that recovery is extremely fragile.
Are you taking any signs from this report, from the commentary that we got on the call, Lee, about this being an economic bellwether for how the economy is doing? You did say that, that B2B communication that typically happens with FedEx, less of that is happening. How are you reading into that?
Yeah, so I think with FedEx, it's two things. So some things are very FedEx specific in terms of their earnings announcement and their lower expectations, and some things are just the macro. For the FedEx specific stuff, they are walked away from their contract with the U.S. Postal business because it was low margin business, and they wanted to restructure their networks so they didn't have as many planes in the air because that's very expensive to operate. So they're kind of decided not to renew that business, and they're restructuring their business. And FedEx is also a company that was extremely bloated, call it 5-6 years ago, and it's now they're really doing the hard work of the productivity improvements that we're seeing within whether it's their drive initiative or some of their other initiatives that are really going to drive margin improvement. The problem is that you need more growth on the volume side to really see those margins improve, and a lot of that growth has to be on the B2B side. And so to answer your question, yes, it is. They are telling us that the industrial economy is a lot weaker. The consumer is, somewhat resilient, but that resiliency, again, I think the two words, if we were playing a drinking game, would be fragile and uncertainty. Every time someone said that, you had to take a drink. I think that, depending on how inflationary the tariffs are, could have a really big impact on consumers. And as you noted earlier, before I came on, that the consumer confidence is kind of like stumbling along, and it's been moderating since the beginning of the year.
Well, that drinking game made its way to our makeup room, where they actually said tariffs would be another one where it would put you on the floor because we say it so much. Hey, one thing I want to ask you, we had a couple of analysts cut their price targets on FedEx today, one downgrade. I'm looking at MarketWatch, who actually noted that Loop Capital downgraded the stock to sell from hold due to the company's vulnerability to an economic downturn. What they said is, with economists ratcheting up U.S. recession risk, be aware that FedEx is a really bad recession stock because thin express margins amplify the earnings hit whenever there's pressure on the top line. It's not one you want to own if things go south. Your own analysis, if things go south, there's uncertainty and then there's recession, which is a recession problematic for FedEx if indeed that happens.
Well, we don't do buy, hold, sell
I know.
at BI. I know. So just with that, the probability of a recession, I think, on the Bloomberg terminal is 25%, and that's up from a low of 20%. So the probability has increased, but it's still extremely low. The U.S. consumer has been resilient. I tend not to bet against the U.S. consumer. I am concerned that maybe they'll spend less. But I would never really bet against them. And when you're looking at FedEx as a company, they are finally in the midst of a transformation that was well overdue. And I think once they come out of this and there's a better backdrop, the benefits to the transformation and the cost cutting that they've been doing is really going to create a more flexible, more productive, and more profitable network.
Right.
So I think FedEx is a very interesting name, not in the near term because they're still trying to figure things out,
right,
but looking past the noise of tariffs.
Lee, we'd be remiss not to ask you about UPS. Just quickly, 20 seconds. UPS is also down about 2.2% today. I know they're different models, different companies, but they do all work in the delivery space. What does this say about UPS, or does it say nothing in terms of what we got from FedEx?
So UPS sold their less than truckload business in 2021, so they don't have that larger exposure to the industrial economy that FedEx does. And then also, I would say that UPS's B2B exposure is around 30 to 35%. Don't quote me on that. It was around that in their U.S. domestic business. So it's not a huge portion of their overall business. B2C is more important for them right now. And I would say UPS is probably like 2 or 3 years ahead of FedEx in terms of restructuring itself to deal with the fact that
right,
e-commerce growth is really going to drive their growth, not B2B.
All right, good stuff. As always, thanks again for that, doing double duty with us over the last 24 hours. Lee Klaskow is Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, joining us from BI headquarters in Princeton, New Jersey. Tim, no doubt about it, FedEx, a great economic bellwether, indicator of business conditions around the globe, so we watch that really closely. And you think about the markets right now, so much on investors' mind, whether coming from the White House, whether coming from Main Street, whether coming from still some corporate earnings.
Yeah, hey, look, I didn't get a chance to talk to Lee about this, but I know you're going to be interested in hearing it, Carol. I took a Waymo to work early this morning.
What?
And yeah, self-driving. Only
Love
the second time I've been able to do it. Yeah, it was amazing. I even talked to one Lyft driver yesterday who told me, and remember, this is a guy who drives for Lyft. He was saying they are such better drivers than humans because they follow the rules. He said he would put a Waymo against 98% of the drivers out on the road.
Wow.
Because, once again, of course, they're going to follow the rules. I just have questions about whether or not this technology can scale. In San Francisco, for people who live here, it's not even a thing anymore. They don't even turn their head when they see one.
Amazing.
But you can tell who the tourists are, who people like me are, who are like FaceTiming with their friends or, you know, family, or showing my kids like, hey, this is a car that is driving without a person in it. And there are so many of them here now, even compared to when I was here a few months ago. It seems like there's so many more.
All right, next time I'm out there, I am definitely going to try one out. All right, guys, so we are looking at a lot of different things, including Waymo seems to be doing just fine, according to Tim. But we know for investors, there's still a lot of challenges. And of course, we just talked about FedEx. For investors, it's tough. They look for a lot of indicators, especially in a stock market, I should say, that's been battered by trade turmoil and growing fears of an economic slowdown. Keep in mind that trillions of dollars have been shaved from U.S. equity values in the past month. And after that 10% correction in the S&P 500, big cap U.S. stocks, while up about 2% from that recent low point, have really struggled to definitively rally, which begs the question, Tim, where are, you know, kind of one of the most time-honored investment strategies, the dip buyers, because they don't seem to be out there.
So let's get to the trade, the day, the recent trends, kind of what we're seeing as we get ready to wrap up the week. We head down to our Washington at DC News Bureau, where we find Ed Harrison, Bloomberg News senior editor. Ed, where do you see things right now? Typically with downturns, or just even pullbacks, I should say, we've seen dip buyers rush in, but we're still kind of hovering around correction territory, at least when it comes to the NASDAQ 100. How are you looking at things?
Yeah, Tim, I think that what we're seeing is that we've gotten the trade salvo, you know, the tariff salvo, and people hadn't expected that, so we saw a correction based upon that. And we had seen some economic surprises that were negative. We actually have more negative economic surprises in the U.S. than positive ones recently, and those two got us to the correction mode. Now the question is what kind of impact are those tariffs going to have, both on inflation and on growth? And then, depending upon that, we're going to see a stock market reaction. I think the FedEx warning is a big warning for the entire market. What it's saying is yes, this slowdown's for real. This is much more than what we saw in 2024 when we had those stagflationary fears. The slowdown is for real.
Wow. Okay. So if the slowdown is for real, the Fed and FedEx maybe were a little bit of a barometer for this, Ed. Then what kind of pulls us out of this? Because I spoke to some folks earlier today and throughout the week here in San Francisco. They weren't necessarily here in San Francisco, but they were on our technology show. And they said, hey, when we get some clarity around tariffs come April 2nd, we're gonna start to see some optimism again. Are they being too optimistic?
They're not being too optimistic. I mean, there are always two sides of the coin. There is the possibility that you know, we get those tax cuts later on, that the impact of the tariffs from an inflation perspective isn't that great. And we saw the Fed talking in those terms, talking about a one-time price step up. They could look through it. They even used the infamous word transitory. So, you know, you do have people of that ilk. But the reality is that we're seeing more layoffs. We're seeing more earnings disappointments and warnings than we had seen when we had a similar sort of stagflationary threat last year. Because if you remember, the Psalm rule was triggered last year, and we had stocks go down almost into a correction. It was like 8.5% for the S&P 500, and we came back. Economic surprises went up, but I think that this is a little bit more difficult a situation, and we'll just have to see how it plays out.
Yeah, and I think the element of surprise, right? Until, I guess, businesses, investors can be assured that, okay, the White House sets policy and sticks to it, until they have those assurances or reassurances, it's going to be tough to, I think, make some decisions. We've already seen it out, just M&A backing off. Ed Harrison, thank you so much, making some sense out of what's been a tricky week. Bloomberg News senior editor Ed Harrison out there in our DC bureau. Hey, coming up, we're going to talk about some of these things that are kind of preventing investors and even the C-suite from doing things, tariffs, supply chains, and so much more. We do get a view from the C-suite in just a moment.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Developing story, the SEC set to see an exodus of staff across key departments as hundreds of employees have agreed to take resignation offers prompted by the Trump administration cost cuts. This is according to Reuters. Developing story right now. Reuters citing 5 people familiar with the matter. Stocks lower for the most part here. Has been a choppy trading session, but right now we're looking at a loss of 10 points on the S&P at 56.52, lower now by 0.2%. The Dow down 25, down 0.1%. Nasdaq little changed on the day, up 2 points there, up less than 0.1%. 10-year 4.25%, the 2-year 3.94%. Spot gold down $26 the ounce at $3,018, down 0.9%. West Texas Intermediate crude 68.22 a barrel, up 0.2%, and Bitcoin down now by 0.6%, just above 84,013 on Bitcoin. Bottom line here, we are seeing a rebound in several big tech stocks, and that is taking us well off session lows. Heathrow, after that massive outage earlier in the day, says operations flights will begin later on today. Hopes to have everything back to normal by tomorrow. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Carol Masser along with Tim Stanovic live here on Bloomberg Business Week. Well, there was one story that caught our attention today. Actually, one of our producers, Elizabeth, pointed it out because it just seemed to tie in so well with our next guest. AstraZeneca will invest $2.5 billion in a new research center in Beijing in a major show of commitment to China just months after that company's top executive there was detained by authorities. We know it is so complicated doing business globally today. Our next guest has separate supply chains for China and Asia and their Western clients, which safe to say comes in pretty handy right now. Here to talk about that and more is Siemens Healthineers Chief Financial Officer Jochen Schmitz, who is featured in this Sunday's Bloomberg CFO Briefing newsletter. Jochen joins us from Munich, Germany, along with our own Nina Trentman. She's here in our studio. She's senior editor at Bloomberg News, author of the CFO Briefing newsletter, which you can sign up for at bloomberg.com/CFO Briefing. Jochen, great to have you here with us. There's a lot to talk about. I do want to start with supply chains because I feel like that and tariffs and globalization is so much front and center right now. Talk to us about how you manage it, build it, think about it, and how what you have today came together.
Yeah, thank you very much first for having me. When I think about our global value-add footprint, we have, as you rightfully said in the beginning, we have, so to say, a two-side strategy. We manufacture and develop everything for China and for the, so to say, China block out of China, and we manufacture and develop everything else also in the Western world. Yeah? That means we have relatively detached two value chains in place. Yeah? This is currently, I would say, for the current situation, kind of a comfortable setup because we are not affected, so to say, too much by the geopolitical or tariff discussion so far between United States and China. When we look at our global footprint in the Western world, 25% of our employees are in the United States. We have 4 segments. 2 of the segments are headquartered in the United States. Our 17,000 total employees, 17,000, as I said, 25% are in the United States. So we are well spread across the world, and this gives us a decent resilience, but it does not make us immune against global trade wars. I also to say this.
Yeah, to follow up on that, Jochen, thanks for joining us. Talk to us about the Trump tariffs. Of course, a lot of moving parts, but how do you think about those, and could there be an impact on your business given that you have a strong U.S. footprint?
Yeah, I mean, first of all, when we look at what is currently in place, the Mexico, Canada, and China additional tariffs, as I said, China is not a major topic for us because latest since so say Trump 1.0, we changed our supply chains so that they are detached from each other. We have, I would say, some impact from some sub-supply from Mexico into the United States for one of our two headquartered business in the United States, our Varian business at the West Coast. This is, I would say, the major impact, but it's not a huge topic. It's so far a small topic. Canada, US, so far not a big topic for us.
And to follow up on that, have you had any sort of conversations with the administration to see if you could be exempt from any tariffs? I know that sort of Beijing, for example, in its retaliatory tariffs on US goods has excluded healthcare.
Yeah, I mean, obviously we are trying to get healthcare and together with other companies in the healthcare sector out of or exempt from tariffs. I think that makes a lot of things sense, because when you think about tariffs, what do? They will limit the flow of products and services across the world on the one hand, but they also will limit the flow of knowledge, and that is to the detriment of patients. Yeah, therefore, when you look at comparable situations like sanctions or others, normally healthcare gets excluded over time, and I'm hopeful that this will also get into play in tariffs, hopefully sooner than later.
Jakob, how do you think about this administration, this president, versus other world leaders that you've dealt with? How is he different to deal with? How is this administration different to deal with?
Yeah, I mean, normally, to be honest, when we in particular in the United States, we do not have a lot of business with government, because the healthcare system in the United States is primarily a private system. Yeah? Therefore, when we look at changes in the administration in the United States, the impact in general on our business, on the healthcare markets, are for us relatively limited. Yeah? And our current assumption as we see it is also with regard to the US market, we don't see significant disruption at the horizon in this regard. Yeah? And obviously, when we look at the Trump administration, it's not a surprise what is happening. Yeah? It was clear. It was also mentioned in the campaign that things like this might happen. From a strategic standpoint, we need to stay flexible, agile, because we cannot plan for everything. There will be surprises, and we need to try to deal with this as rapidly as possible.
I am curious, there was a story out today, actually from Dow Jones, that talked about how you guys are setting up 2 cancer research centers in Alberta, Canada, focusing on oncology training and artificial intelligence and machine learning. And I guess what I want to ask you is, do you see, because it does feel like for so long, or the last couple of months, we talked about American exceptionalism, that doing so well, growth, and still investment coming in. But I do wonder, do you think that the U.S., as a result of this administration and the policies that are coming out, is potentially putting an end to that exceptionalism and maybe cutting the U.S. off from collaborations, whether it might be with your company or with healthcare in general, or research, whether it's AI, whether it's in healthcare, and so on?
My personal opinion is a clear answer is no. Yeah? Oh. This will not happen from my standpoint. We also do not see this currently. We first of all, we are a huge company in the United States. As I said, we have 2 of our segment in the United States. We have more than 17,000 employees in the United States. We run here out of the United States, I would say by far most successful global radiation therapy company in the world, Varian, and we have a very, very strong lab diagnostic business out of Tarrytown, New York. So I think we are very US-ish also, like we are very European, like we are very Chinese. We are really a global company with a very well spread global footprint. And I can't imagine that the United States will harm their people to that extent that they will cut off research in healthcare and really do crazy things in this regard. Because as I said in the beginning, this will all ultimately would go to the detriment of
Right.
patients, and that will not.
So
I can't believe.
So just to clarify, this idea of American exceptionalism being gone, dead, if you will, you don't agree with that?
Yeah, I don't agree with it.
Okay, great.
To follow up, Jochen, you're based in Germany. A fair amount of your value creation is there, but only I think 45% of your revenue comes from there. Talk to us a little bit about the change in government that we're expecting, and how far you're seeing that potentially improving competitiveness in Germany, a topic that you and I have talked about in the past.
Yeah, I mean, as you rightfully said, the German market per se is for us is not unimportant, but it's not super critical. Yeah, it's 4 to 5% of revenue. Yeah? But when we look at Germany as a country, I think we need to have a change in how we administer this country. I think the first steps we have seen here are promising. There were at least decision-making, pragmatic decision-making. The supposed to be new government established itself. I call it a very nice credit line of 1,000 billion euros. But this is, I would say, very comfortable to have on the one hand. On the other hand, it does not release this government from making tough decisions on leaning up the bureaucracy in the country and reformatting, so to say, the social systems. Yeah? Because otherwise, also this nice investment program will not find its way or will not pave the way to sustainable growth.
So that means you'll hold off for now with new investment decisions for Germany, or sort of what's your take on that?
No, that's not the case. I mean, for us, we have a significant value add in Germany. We see the circumstances for us in Germany as a value add location still very positive. We have maybe also because of the industry we get very good people. The education system is still attractive to what we need, and I think we are ongoing. Well, we will continue to invest. We have invested in the last 3 to 4 years or 3 to 5 years, about 650 billion euros in Germany, and this is a significant investment, $1 billion.
30 seconds, very quickly, Jan. Jan, I wonder, what's the biggest kind of interesting trend, disruption that's going on in your industry right now? And I do have to ask you to be very quick.
I think our industry is not an industry which is driven by disruption because it's about the health, I would say, the health of patients. Obviously, AI will play a constantly more important role, and those who do not build their case on AI will not succeed.
Well, super interesting, and so appreciate your time. We covered so much ground. Jochen Schmitz, CFO of Siemens Healthineers, and of course our Nina Trentman, Senior Editor at Bloomberg News. Be sure to check out the CFO Briefing newsletter. A new one comes out on Sunday. When we come back, C-Suite continues. Carnival CEO Josh Weinstein.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story. Headline right off the Bloomberg Professional Service. Clear Lake said to be near a deal to buy Dun & Bradstreet for about $9 a share. We got DNB shares up now by just about 3.5%. Again, that headline on the Bloomberg. Clear Lake said to be near a deal to buy Dun & Bradstreet for about $9 a share. And again, Dun & Bradstreet right now at $8.77. It is up by 3.4%. A rebound in several big techs, driving stocks well off session lows. In fact, the S&P could see a gain on the week. First time that has happened in 5 weeks. Right now, we have got the S&P lower by 10, 56.52 where we stand right now, down 0.2%. Dow Industrials down 33, a drop there of just about 0.1%, while NASDAQ holding on to a 9-point gain. The NASDAQ Composite Index up under 0.1%. 10-year 4.25% with a 2-year 3.94%. Gold down $24 the ounce at $3,020, down 0.8%. West Texas Intermediate crude up 0.3%, 68.26 a barrel on WTI, and Bitcoin down 236 right now. It is down 0.3%, 84,273 on Bitcoin. London's Heathrow Airport slowly recovering from an unprecedented day-long blackout that brought travel to a standstill for hundreds of thousands of passengers. Everybody's going to have a story about this one. Right now, we have got ADRs of IAG. That is the parent of British Airways. They are trading lower, down by 2.2%, down at $7.34. International Consolidated Air is the full name of that company. Among U.S.-based carriers that have significant transatlantic operations, American up now by 0.1%, United up 0.7%, and Delta lower by 0.4%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Well, Carnival reported earnings, and the stock at one point sold off more than 6% on the news. This after a key quarterly earnings forecast trailed estimates, adding to worries that a travel slowdown has spread to even the most robust corner of the market. However, Carnival did boost full-year profit expectations, beating Wall Street's view, suggesting any slowdown may prove transitory. I do want to point out, too, the stock is down about 15% so far here in 2025. Let's get some context and more detail around the company's quarterly update. Great to have back with us Josh Weinstein. He's President, CEO, and Chief Climate Officer of Carnival Corporation, and he joins us from Carnival's headquarters in Miami. Josh, great to be talking with you. How are you?
I'm very well, thank you. How are you doing?
Doing okay, trying to keep up with everything that's coming at us on a daily basis. And I kind of want to start there because there is a lot coming at anyone who's running a big company like yours today, whether it's out of Washington, whether it's out of how the consumer is feeling. How would you describe the cruise business and how it compares from your last quarterly update? What has changed at all? Because I know you have been very optimistic, and it seems like you're still optimistic about the business based on the releases.
Yeah, absolutely. So the thing that's changed from December to today is, well, we just completed our first quarter, and instead of yields being up 4.7%, which is what we guided to, they were up 7.3%. And so clearly things went very, very well in the first quarter. Consumers love to cruise, and we've got 8 brands that are purposely tied to particular demographics, particular national markets, and it serves us very, very well. And so what we see is enough strength in that first quarter that we can raise our yields for the year, for our full year guidance. And that's basically saying that we're content to keep 4% plus yields for the remaining 3 quarters of the year, despite the fact that there is, geopolitical and macroeconomic uncertainty, which certainly wasn't on the radar when we came up with our guidance to begin with in December.
And yet investors seem to be, at least initially, disappointed over your second quarter EBITDA forecast. Your forecast was $1.32 billion in the second quarter. Analysts had expected $1.35 billion. Should they be disappointed?
You know what? I guess I'll answer by saying our December guidance was basically saying we were going to be about was it $1.70, give or take, for the year on EPS. We just came out with guidance that said $1.83. Mm-hmm. We outperformed on revenue yields. Onboard trends are really, really healthy with our consumers. So I would argue that we should be higher than where we were in December, since our results are better than where we were in December. But that's really up to the street. Our job is to deliver and hopefully over-deliver, which is what we did in the first quarter.
So Josh, let's talk a little bit more about that consumer, because in the press release, you noted that Carnival's not completely immune from heightened macroeconomic and geopolitical volatility, and you're still taking up earnings expectations for the year. You remain on track to have another stellar year across the entire brand of cruises. Why are we hearing then from airlines that consumers are pulling back? Why are we not seeing that in your business?
Well, I think there's a couple of things to differentiate. First of all, airlines aren't just for holidays. Airlines are business travel. It is holidays, it's conferences, it's government travel. We are really holidays. We are vacations. So we're in a different bucket than where airlines are. You know, we came into 2025 the best book position we've ever been in at higher prices. We came out at the end of the first quarter still being in line with record occupancy percentage and prices still nicely higher. We're 80% booked for the year. And so we have relatively limited inventory to sell when it comes to 2025. At the same time, our guests and our brands aren't just focused on in-year. You know, we just came out of the first quarter of the wave period, which is considered the traditional big push for selling. And we set a record for the most volume we've ever done during wave for future years out. So people aren't just thinking about the short term, they're thinking about the long term, which is exactly what we're doing as a company.
But are you noticing any change in the tone of the bookings, the pace of the bookings, or perhaps even people canceling because of their own uncertainty? I understand there's this difference between discretionary spend and business spend, but after all, discretionary is discretionary, and that's often the first thing to go if people are feeling uncertain.
Yeah, you know, we haven't seen any noticeable change in trends on cancellations. Certainly, as we mentioned on the call, you know, there were ups and downs over the first quarter. There's ups and downs all the time. But we got through our period exactly at pretty much the highest point that you can get at least for us in our history. And we feel good about the position that puts us in. Like I said, onboard spending, you know, was up about 10% year over year in the first quarter. That's an acceleration of year over year performance versus where we were in the fourth quarter. And at least into the first couple of weeks of March with cruises that have ended, we really haven't seen a slowdown in that consumer behavior, that onboard spending. And so, you know, at the end of the day, people in good times and bad times, they take holiday, they take a break, they need a break. You could argue in bad times, they need that break even more than they do in the good times. And that's what cruising is. It's a break, it's a way to relax, to get away from things, enjoy time with friends and family. That's what people pay for now. And when you line up cruise versus other vacation alternatives, frustrating as it is for me as a CEO of a cruise company, we're a great value. And the fact is, if people are getting concerned, if there's uncertainty, if there's noise in the background, people are searching for more value for their money, and that's exactly what we do. So it plays very well into our strength.
So just for the record, I could go on a cruise for about a month right now because I need a break. But
We'd love to have you. We'd love to have you.
Having said that, what about in terms of pricing? Are you guys able to maintain pricing? Nothing changing in that regard, either for the first quarter or even for the outlook for the second quarter?
Yeah, you know, so like I said, the first quarter, you know, our yields year over year were up over 7%, and over a 2-year period, we're talking about 24% higher yields for the first quarter. When we look at the rest of the year, Q2 through 4, we're projecting a little bit over 4% yield improvement year over year for that 9-month period remainder of the year. So, you know, look, it's hard going, right? It's not like anything is easy, and we got to work hard. Our brands work hard to make that become a reality, and they do it through good revenue management techniques, through the great advertising that they're doing, and then ultimately delivering onboard experiences that people want to pay for. And then they get off of our ships, and they tell their friends and family how amazing it is, and we get more.
Hey, one of the things we wanted to ask you is something that in late February, the U.S. Commerce Secretary Howard Lutnick, he made some comments about how U.S.-based cruise companies, Josh, should be paying taxes even on ships that are registered abroad. We saw your stock, along with everybody in the major cruise space, sell off on his words, even though analysts indicated the worry may be overblown. They said, we've heard this before over the years. Is it overblown? Are you talking with the Trump administration about this? And if there was a U.S. registration change, what would that mean for you guys?
So clearly, we're operating in the confines of U.S. law as well. We should. International shipping is based on very specific tax regimes that are set up in the U.S. and all over the world, and effectively, it's based on reciprocity. So we feel like we're in a good place. We're doing what we should be doing. Having said that, anything out of the administration, including Secretary Lutnick, we certainly take seriously, and we're working hard to understand what the concerns are and how we can address them, if any. There's really nothing to report on from my perspective as far as what that means or where things could be going. But we'll stay on our guard and do whatever we need to do to make sure we're staying on the right side of policy.
Josh, why don't you register in the U.S.? Is it regulatory reasons? Is it tax reasons? Is it labor reasons? Is it all of the above? Why don't you register in the U.S.?
Yeah, it's just not that simple. You don't just take a ship and all of a sudden you can't just switch to U.S. registry. It's just not that simple. And really, it's a people go to school for classes for this, right? About international shipping and what it means, how it works, and it's been in place for much longer than I've been alive. And so we could do a separate session on that, but suffice it to say. It's a regime that is well founded, and it's where we are right now.
All right, so it's not something that we should think about. I mean, it can be done, though, right?
What is the it?
In terms of registering in the United States?
It's honestly not that simple based
Okay.
on how U.S. law works. It's just not that simple.
Okay. Would that be a conversation, though, then to have with the Trump administration, Josh, and say, listen, guys, if it was simpler, I mean, they're all about making things simpler, right? Efficient. Is there a conversation to be had?
Oh, we're happy to talk to the administration, truly.
Okay. Hey, listen, one of the things we wanted to talk to you about in a big way, and I've seen it firsthand, is the island destinations that you guys have. And it seems to be a continued, move for you guys and expansion. You opened Celebration Key this July. This is in Grand Bahama Island. How do these island destinations, we've talked to you about it, but it continues to be something we find really interesting. How does it fit into the North American cruise strategy and how important it is? I always think about to the top line, the profitability picture.
Yeah, so for us, what we're doing with Celebration Key, which opens in July, it's a bit of a first for us. Even though we have a wonderful footprint around the Caribbean, we've built and created these destinations really as a service to our brands and something that's supportive of and really supplemental to what brands are doing and leading with a cruise experience that makes them so loved. What we're doing with Celebration Key, which doesn't even exist yet, and yet it's captivated the audience and captivated the imagination of Carnival cruisers and others, is we want to also lead with destination as a driver of consideration, of a driver for people saying, I need to go on Carnival Cruise Line because I'll get to go to Celebration Key, or because I'll get to go to Relax Away Half Moon Key, because it's the only way to get there. And so we believe that there's a tremendous amount of untapped value there in revenue generation, as well as the fact that these destinations are built close to the United States, hence we consume less fuel in order to get there, which saves money, is obviously good for the planet.
Hey, listen, 20 seconds left here. What is your most popular destination? Where do most people want to go? And what kind of trip?
Well, we carried 13 million people
I know.
last year. They want to go to a lot of places. I'd say if you were going to ask me what's my top that I've ever been to, I got to say you got to go on a cruise to Alaska. And you got to go with Princess, Holland America, or Carnival, because they do it in an amazing way. And Cunard for those who are looking for the luxury end. But if you want to see the great state, the only way to do it is with a great brand that can take you on both sea and with our land experiences, because we've got hotels and motor coaches and glass domed rail cars and you name it, we got it up in Alaska.
I just want to go somewhere where I get a cocktail with a little umbrella in it. I'm that easy.
We also serve cocktails with umbrellas when we go to Alaska.
Josh, thank you so much. Always appreciate the time you give us. Be well, be well. Josh Weinstein, President, CEO, and Chief Climate Officer of Carnival Corporation, joining us from Carnival's headquarters in Miami. All right, so Tim, Carnival, great read always on the consumer. So too is Nike.
Yeah, Nike shares are dropping to their lowest since March of 2020, at least earlier in the session, sending the sportswear company's market value below $100 billion for the first time since the depths of the COVID-19 pandemic. This after the earnings report from the company signaled that revenue and profitability will remain under pressure. Kim Basine follows the company here at Bloomberg. He's Bloomberg News celebrities and athletes reporter. He joins us in the Bloomberg Business Week studio in New York. First up, the quarter. Kim, what exactly is dragging down the business?
Well, it's like a couple things here. First off, inventory at Nike is really high. So over the last few years, Nike focused on a set of 3 product lines: the Air Force One, the Air Jordan 1, and the Dunk. It turns out they made way too many. Demand recently has fallen off for those 3 shoes, and there's not a whole lot to replace that with. So they're clearing out all this old inventory. That means, you have to heavily discount. And on top of that, they said that tariffs on China and Mexico are going to drag on their outlook going forward.
I gotta say, Kim, I keep thinking, is Nike, forgive me, don't send me hate mail on this one, people, still relevant as a sportswear company and brand? I mean, it sounds like, are they just missing what the market wants right now?
You're asking if they're cool, Carol?
It seems like you're asking if they're cool.
Okay, I am asking.
When you look back
Kim
at
is
it,
the right person to ask, by the way, about whether something is cool or not.
That's why I ask.
over the last few years, Nike went a little bit away from sports, and that's a weird thing to say, right? Like you really equate Nike with running and basketball and all these sports things, but they moved away from that to those like lifestyle shoes, right? The 3 lines I just mentioned. The new CEO who started back in October, his name's Elliot Hill. He has immediately moved to take Nike's identity back is one of the ways he's been putting it.
Right.
Which means getting back into sport, getting back into these big anthemic ads where you can see what Nike represents and what it is. So that's what he's really been. They aired their first Super Bowl ad in decades at this Super Bowl with this new CEO in charge.
With a lot of women.
With a lot of only women.
It was only women. It was a really cool ad, Tim. Just going to point out. We women, we're going to save Nike. I'm just going to put that out there.
Well, speaking of the Super Bowl, Kim, you ran into Elliot Hill at the Super Bowl, right?
I did run into Elliot Hill at the Super Bowl.
Why was that such a big deal?
Because he's out doing the full road show, right? Like so he went to the Super Bowl.
But it speaks to the culture that he's trying to bring back to Nike. Like this is a long time. This is somebody who Nike employees love. They love that he came in. He understands the brand. But does he? Like what is he doing to bring it back to its glory?
Yeah, he went to the Super Bowl. He had a nice weekend there. He hosted a party for Jordan Brand. He met a bunch of his athletes. A week later, he was in San Francisco and out there at NBA All-Star Weekend, again meeting athletes, wearing their shoes, like debuting their shoes out in public and everything, and helping them launch whatever the next thing is. That's really important. Nike, he said it's about the athletes. We're going to put the athlete first. That means both the athletes that you see on TV, on the court, on the fields, but also like the people who wear the shoes. It should be for athletes. So these performance shoes are going to be a real priority for Nike going forward.
Just about 30 seconds. Is that still kind of the golden playbook for Nike, or just for almost any sports brand, to just get the right athletes with the right product and it's just killer for them?
Some of it is, but some of it is also finding the right thing in culture to chase, like being a part of being as integral to all of culture as possible, and that means like hitting everything right on the spot.
What about platform sneakers? Aren't they like kind of back? Isn't there somebody doing? Yeah, one of our producers, Elizabeth, has platform sneakers. I don't know. What do you think, Kim?
Yeah, sure, why not?
Listen, an important company and one that we watch so closely, and certainly love your reporting on it. Really an inside look. I should point out that Nike shares were down as much as 9% in today's session, but still a decline of about 5.5%. So come off a little bit, but still down. Kim Basine, thank you, as always. Have a great weekend. Celebrities and athletes reporter at Bloomberg News here in studio. All right, for those of you watching on TV, the close is coming your way with Scarlett Fu and Alex Steele. Tim and I continuing on Business Week. Our C-suite conversations continue. We're going to talk with the president and CEO of HPE. That's coming up next. This is Bloomberg.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Michael Wallace. A federal judge is holding a hearing on whether the Trump administration ignored his order blocking the deportation of alleged Venezuelan gang members last week. The judge is pressing the Justice Department on how quick the deportations were, giving the men no time to file challenges. CBS's Camilo Montoya Galvez has learned some of the men may not have been gang members. He explains how ICE rounded them up.
One of those techniques relies on looking at international and domestic criminal databases for intelligence or criminal records that suggest that somebody may be part of a gang. They also rely on interviews with current or former gang members, as well as the victims of potential gang members, to make these accusations.
The wife of detained Columbia University grad student Mahmoud Khalil is breaking her silence. Noor Abdallah tells CBS Sunday Morning about his arrest by ICE agents.
My husband was taken away from me in the middle of the night. It was one of the most terrifying times of my life. I don't think I've ever experienced anything scarier than that.
President Trump wants Khalil deported. There are questions over what Elon Musk was doing at the Pentagon today.
Both President Trump and the defense secretary say Elon Musk was not at the Pentagon to discuss how the U.S. would fight a hypothetical war with China.
We don't want to have a potential war with China, but I can tell you if we did, we're very well equipped to handle it. But I don't want to show that to anybody. But certainly you wouldn't show it to a businessman who is helping us so much. He's a great patriot. He's paying a big price for helping us cut costs.
Elon Musk has been trying to expand Tesla in China. At the same time, he's leading the Department of Government Efficiency, cutting federal spending. Linda Kenyon, CBS News, Washington.
Flights have resumed at London's Heathrow Airport after it was shut down for 18 hours due to a power outage. The BBC's Rich Preston is there.
After this day of chaos caused by that one fire at one power station, that things may be starting to get back to some semblance of normality, with Heathrow Airport themselves saying earlier that they expect a normal schedule to run tomorrow, Saturday.
Israel's Supreme Court has temporarily blocked the firing of Ronen Bar, the head of Israel's domestic intelligence service. CBS's Linda Gradstein is in Jerusalem.
In a letter, Bar accused Israeli Prime Minister Benjamin Netanyahu of deliberately sabotaging a deal for the freedom of the hostages and for ending the war in Gaza. He also said that his firing would mean that an investigation that has been started into whether the country of Qatar bought influence in the Prime Minister's office would be sabotaged.
Thousands of Israelis have taken to the streets this week protesting Barr's dismissal. Dow futures down 59 with an hour of trading to go. This is CBS News. More people upset with all the job cutting by Elon Musk and Doge are trading in their Teslas.
Edmunds data reveals 2017 and newer Teslas accounted for 1.4% of all the vehicles traded in during the first 2 weeks of the month, a record for the brand. That's up from 0.4% during the same period last year. The car shopping website says Musk's, quote, increasing public involvement in government, Tesla depreciation concerns, and its increased saturation in major metro areas are affecting the loyalty of longtime Tesla owners. Christopher Cruz, CBS News.
California now has more electric vehicle charging stations than gas nozzles. There are 178,000 charging stations statewide, not including the million chargers people have in their homes. The state has 120,000 gas station nozzles. A quarter of all new cars sold in California are electric, and sales of new gas-powered cars will be illegal by 2035. Michael Wallace, CBS News.
This
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, here we go, everybody. Getting ready to wrap up the Friday trade on Wall Street. We've got about 55 minutes to go until that happens, Tim. I'm Carol Massar along with Tim Stenovec.
Why, are you counting down, Carol? It sounds like you're counting down to Friday night. Did you order your pizza yet?
No, but I get off air and I get to my app and I order it. Yeah.
I know.
And you are going to pop on a plane.
Yeah, I'm going to be on a plane. I probably won't get any pizza. I'll try to get maybe a burger in the airport or something. We'll see if I have time. I don't know. Enough about me. Let's talk about what we got coming up on this program, because we got a great couple of hours. We've been talking a lot about NVIDIA GTC. It's been happening in San Jose this week, a little bit south of me. We're going to talk to an executive who was there and met with Jensen Huang. We're talking about Antonio Neri, the president and CEO of HPE. He's going to be joining us in just a few minutes.
Yeah, I'm really curious about that conversation, his insight when it comes to NVIDIA and just the world of artificial intelligence, also quantum computing for that matter. Hey, also, we're going to go pretty deep when it comes to supply chains. We've already talked about that a little bit in the last hour. We're going to do so this hour, though, with the managing director of supply chain finance over at Wells Fargo. It's a thing, everybody. It's an important thing, certainly for a lot of businesses out there.
You hear about the eggs that the U.S. is importing?
I did not. Where are they coming from?
Okay.
Where are they coming from?
Italy. Are they? Yeah, we're going to talk a little bit about that later.
Do they come with some Italian food?
Yeah, just the eggs ahead of Easter and Passover.
Yeah, okay.
Hey, what? Today's big take, the crypto windfall. That's funding a $1 billion space station dream. It is today's big take. It's one of the most read stories. Pretty cool stuff. Kyle Porter is going to be joining us from Chicago in a little bit.
All right, looking forward to that. Let's get back to the trade. We are off our worst levels of the session, but still right across the screen. Let's check in once again with Charlie Pellet for your top stories. Hey, Charlie.
Thank you very much. Indeed, the Dow, the S&P, NASDAQ, all lower. Just about 53 minutes to go ahead of the closing bell. Got to stick around because this will be interesting. Right now, we have got the S&P on the week. I'm looking at the weekly numbers up by roughly 0.1%. We have had 4 consecutive weeks of losses, so going to be very interesting to see if we can eke out a gain on the week. Right now, we're looking at a weekly gain of 0.1% on the S&P. Red on the screen, though, with the S&P down 20 right now at 56.42. That is a drop of 0.4%. We've got the Dow down 0.2%, while NASDAQ lower by 0.1%. Russell 2000 index of small cap shares down 0.6%. Your 10-year 4.24%. The 2-year 3.94%. Spot gold down $26 the ounce at $3,018, down 0.9%. And West Texas Intermediate crude oil up 0.4% right now, $68.35 a barrel. As for markets, tariffs, and the outlook, Seema Shah is chief global strategist at Principal Global Investors, and she was interviewed this morning on Bloomberg Surveillance.
So much really depends on what can we expect to come through from a stimulus perspective, not just from the Fed, but in terms of what happens to tariffs in the second half of the year. Are some of them going to be lifted? Are we going to expect to see deregulation? If that comes through, then there are parts of the market that stand to gain over the coming months. But as I said, I think the jury is out until we have some further clarity of where this administration is going with a number of their different policies.
Principal Seema Shah interviewed on Bloomberg Surveillance. Big news this morning. You heard it live on Bloomberg Radio out of the White House. Boeing has won a contract to design and build the U.S.'s next-generation fighter jet, beating out rival Lockheed Martin for the contract. Boeing up 3.9% right now. We do have Lockheed Martin lower by 6.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Well, we spent a lot of time this week talking about NVIDIA GTC. It's the annual developers event at San Jose. It's been dubbed the Super Bowl of AI. Our own Ian King writes today that NVIDIA CEO Jensen Huang's presentation there was all about how to get a return on the expensive gear being installed now. And he spent a good rest of the week reinforcing his message designed to counter increasing concerns that the sustainability of spending and encourage executives in the broader economy to join his vision for the future. One executive who was there was Antonio Neri, the president and CEO of HPE. Antonio joins us from HPE's headquarters in Spring, Texas. Antonio, good to see you. Welcome back to the program. You spoke with Jensen earlier this week at the event. What was your big takeaway? What did you learn? Because investors certainly weren't as impressed as they have been in the past couple of years.
Well, good afternoon, and thank you for having me back. It was a fantastic event. Obviously, you can look at from many different perspectives. Number one, the innovation front. I have to tell you, I've never seen such innovation at the speed that we are all experiencing. You know, 2 years ago, we were talking about the boom of generative AI. Now we're talking about physical AI, robotics, and what can do for manufacturing and other industries. On the other hand, obviously, you talk about what this can do for the enterprise. And the enterprise, what I see, particularly in the last 90 days or 180 days, is an acceleration of deployment because they all realize that AI has a tremendous potential to improve productivity, to improve business processes, and deliver value to each of the businesses. And last but not least, obviously, what they can do for society. And if you think about the opportunity to address some of the societal challenges, whether it's finding new cures through molecular docking research or weather forecasting and many other type of use cases, is all there. Now, we have to see it, we have to build it, and we need to see it through the benefit of it over a period of time that people need to live with.
Well, we also heard, Antonio, this promise of physical AI. That was one of the big themes that emerged. And look, I'm in San Francisco right now, so I get to see the Waymos driving around, a little peek into the future. But from your perch at HPE, what's the future that you see? What's the future that you envision with physical AI?
Well, I see a world where basically we can remove the humans that they are in the loop and be on the loop, where some of these physical AI, robotics, and other type of applications can do the basic task which were totally automated, where we can use ourselves, the humans, for other more interesting and value-added tasks. And that will drive a level of productivity we haven't seen before. And that applies to every industry. You talked about autonomous cars. Obviously, that includes a lot of artificial intelligence, machine learning, and other techniques. But when I think about the other industries, the potential is enormous. Now, not everything will be applicable, but I think, we see a world where AI will be embedded in everything we do.
One of the things I wanted to follow up on, and you guys made is actually an announcement kind of off of this event about you and NVIDIA coming up with some new enterprise AI solutions, working on this together. Antonio, what I wanted to follow up on, though, you said we have to build it, we have to see it, and to see what the payoff really is. That's what, like, the last couple of years, right, have been about, this build out, this spend. And we continue to see partnerships to continue the spend. But how long do you think it will be until companies really have an idea of what payoff they get for their investment?
Well, look, Carol, I see it already today in our own company. We deploy AI in many of our business processes across finance, digital marketing, customer service, forecast planning, and the like. And even on the R&D side, our level of productivity in our software development process has improved by 30%. So the learning here is that, first of all, it takes time to build infrastructure, but for enterprise, it's not a big of a lift from an infrastructure perspective. I can tell you in my own company, I have only a couple of hundred GPUs, and it's plenty for what I need to do, compared to the service providers, the model builders, that many tens of thousands of hundreds of thousands, for that matter, to build these large language models, which are very sophisticated, from what I call generative to agentic to reasoning, and eventually these models that will do the robotic side, the physical AI. But inside the enterprise, we already see the benefits, and I spend more than 50% of my time talking to customers, and they are going from the experimentation phase to more deployment side. And that's why the last quarter, we saw a 40% increase on a year-over-year basis, the demand for enterprise AI solutions. And obviously for us was the deep partnership with NVIDIA, where we took their software stack, the famous CUDA environment with the NIMs and agentic approaches, including only partners, with our infrastructure and our own software in the cloud. And there is all about time to value. Basically, we made it so simple, 3 clicks, less than 30 seconds. You can deploy an environment for your developers to RAG or fine-tune a model with your data, or to deploy inferencing. And that's where the acceleration is going to come, the simplicity of deployment with the use cases that can return that investment very, very quickly.
It's all just kind of really, really cool stuff, and something we think about so much. It's happening now, but really kind of what the future means and the impact. I do want to ask you, though, about today's environment. There's so much coming at CEOs, the C-suite of companies, a lot of stuff out of Washington, and we continue to watch the spending when it comes to IT. Given some of the recession fears that are out there, what has your conversations with CEOs revealed on the spending environment? Any signs of pullback, any signs that a recession might be coming? What color can you give us about that?
Well, up to our Q1, which ended on January 31st, the demand has been very strong. In fact, if you look at our own demand for a moment for our networking business, our hybrid cloud business, and our AI business, which are the three pillars of our company, we saw double-digit order growth demand for every solution that we have available today in the market. Now, that said, the conversation today in the market about tariffs, some of the geopolitical tension, the work that the United States is doing to control spend, obviously is causing a little bit of uncertainty. But I do believe IT is one of those areas where spend will be protected, because ultimately, whether you think about position yourself for the next wave of the supply chain through digitization and automation as you rebalance the supply chain, where it makes sense for you, or whether you think about using your data to your advantage, as a great example, using AI, or whether it's to simplify your processes, it will require IT. And that's why I continue to be positive about the spend of IT as we think about the next few years, because it will grow, in my mind, faster than GDP.
All right, we're going to have to leave it there. Antonio, thank you so much for giving us some time. We greatly appreciate it. Our thanks to Antonio Neri. He's president and CEO of HPE, of course, as you know. Stock right now in today's session just down about 1.3%. Has had a lot of pressure on it, though, this year. Down about 25% here in 2025. Company did report earnings back in March 7th, earlier this month, and there were some concerns about the weak profit outlook, but you can certainly read a little bit more if you want at Bloomberg.com and, of course, on the Bloomberg terminal. Hey, coming up next, Tim, we're going to talk a little bit more about supply chains.
Yeah, we're going to be joined in just a few minutes by the person over at Wells Fargo, Managing Director of Supply Chain Finance at Wells Fargo, who handles that. In the meantime, we're still seeing stocks in the red today. The S&P 500 down 0.4%. The NASDAQ down by 0.1%. You're listening to and watching Bloomberg Business Week.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ, and the NASDAQ 100 index all trading lower right to the numbers, with the S&P down 23 right now. 39 minutes to go until the closing bell. Right now, the S&P down 24, down 0.4. The Dow is down 0.3%, down 126. NASDAQ down 33, a drop there of just about 0.2%. The 10-year 4.24%, the 2-year 3.94%. Spot gold down $23, the ounce down 0.8%, 3,021 on the precious metal. West Texas Intermediate crude up 0.3%, WTI 68.29 a barrel, and Bitcoin now down 0.5%, 84,074. So with all the selling, is this time to be jumping in? Kate Moore is Chief Investment Officer at Citi Wealth at Citigroup Global Markets, and she says, no, it's still too early.
You know me, I like risk. I've always liked to look at opportunities. I like to see when there are dislocations and say this is a nice time to step in. And right now, not just in terms of the macro forecast, but also in earnings, it's almost impossible for me to say we've seen the bottom, we can break out of this trading range, and it's time for us to add.
Kate Moore of Citigroup Global Markets. London's Heathrow Airport says it is slowly coming back from that unprecedented day-long blackout that brought travel to a standstill for hundreds of thousands of passengers at Europe's busiest airport. Authorities say the airport will likely see interruptions continuing for days. Meantime, the UK Metropolitan Police says its counter-terrorism command is now leading the probe. IAC, the parent of British Airways, its ADRs down now by 2.3%. And among other U.S. carriers with significant transatlantic routes, we've got American up 0.3%, UAL now up 0.5%, Delta down 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, today, Brendan Carr, chair of the U.S. Federal Communications Commission, is preparing to block mergers and acquisition proposals, let's say that again, from companies that promote invidious DEI policies. That was his word. The move could threaten billions of dollars worth of deals in the communications sector. Carr specifically mentioning Paramount Global's merger with Skydance Media, also Verizon Communications acquisition of Frontier Communications parent. So this certainly caught our attention. Let's see what we need to know a little bit more about. With us right now is Simone Foxman, Bloomberg News Equality Team reporter. She's here in our Bloomberg Interactive Brokers studio. All right, first, what do we know? And is this a done deal? Is this going to be an executive order? Like, what do we know?
So what we understand from Brendan Carr really came from interviews where he's talking about, quote, invidious DEI, and talking about potentially blocking any companies that apply for a merger approval, but that are doing this. I mean, he essentially says, and I quote here, "We can only, under the statute, move forward and approve a transaction if we find that doing so serves in the public interest." Now, that said, so I guess it should be mentioned that most of these companies have some sort of diversity programs. Some of them, including Paramount, have pulled back on tidbits of these programs recently, in part to reflect the messaging of the Trump administration and some of the executive orders that we've seen.
Right.
But now they're going to be faced with, what do we do with what remains? Most of them have continued to say that they're committed to diversity and inclusion, in some words that are very similar to that.
Or in the case of JP Morgan, just renaming DEI program to DOI. I'm just going to say,
yeah,
it's still a diversity, equity, and inclusion program. Tim, I know you've got thoughts on this.
Yeah, well, is this legal, Simone? Is it legal for the FCC to do this? Is this another thing that's just going to be challenged by courts that the Trump administration has done?
I mean, I'm sure this will be challenged by courts, right? I mean, how many mergers have we seen taken up all the way to the court system? But what I found really interesting...
what I mean is not even the mergers. I mean just the concept of this, whether or not this is grounds for approving or not approving a merger. Is that something that can be tested by the courts?
Absolutely. We expect a lot of lawsuits over whether or not companies and the limits of companies' rights to say what they want to their own employees, especially when that doesn't necessarily conflict with the law. No company here is going to tell you that their DEI policies, or whatever they call them these days, are out of step with the law, or else they'd change them. And frankly, it remains to be seen exactly what they will decide to save here, what they say that falls under this DEI umbrella, that they say we want this, but we can do without that. We have already seen at least 2 court cases about this issue, both calling the Trump's efforts vague, void of due process, and also saying that companies and organizations that receive federal money, whether contractors or as grantees, have some rights to free speech. Both of those are being tested now. What we haven't seen, though, is corporate America really come in and try and fight that fight. We haven't seen that.
I mean, I don't even know how to get my head around this, to be quite honest. I mean, there isn't any... We know the government has made a decision about within the government when it comes to DEI policies, and we know that there's been also language coming out to apply that more broadly. Having said that, it's not like there's a law that has been created, right? I mean, God, I don't know, is that the next step? Does Congress somehow get involved?
So the EEOC, the Equal Employment Opportunity Commission, and the DOJ, I believe yesterday, this week certainly, came out with some guidelines that they wanted to set around DEI that are informative. And lawyers that I speak to on this subject, you're watching them very closely. What they take issue with are programs that are specifically only available to certain groups, whether that's women or Hispanic people or people of certain nationality or descent. They take issue with that. They take issue with any policy that seeks to discriminate against a specific group. I would say, though, most of corporate America has already done away with a lot of policies that were really exclusive. Women is kind of a separate issue and kind of that maybe will be addressed differently, but especially related to things like race. But you have to wonder about things like disability as well, veteran status.
Other lines, right?
All these things, fall within this broad DEI umbrella. Most companies have rolled things back that they think are legally risky, but there's plenty of things like maternity and paternity leave, like employee resource groups, like diversity councils and stuff that don't necessarily violate any specific law that companies may very well say, we want to keep this.
All right, another interesting development, no doubt about it, keeping everybody on their toes. Simone Foxman, thank you so much. Bloomberg News Equality Team reporter right here in our Bloomberg Interactive Brokers studio. Tim.
Hey, we're getting some headlines that are keeping me on my toes. The ticketing platform StubHub Holdings has filed for an IPO. That IPO is set to be led by JP Morgan, Goldman, Bank of America, and TD Cowen. We're getting some details about the company's business in that IPO filing that I want to share. 2024 revenue came in at $1.77 billion. 2023 revenue was at $1.37 billion. And 2022 revenue was at $1.04 billion. So we're seeing some growth there, though it does have a loss per share in 2023 of 91 cents. That's 2024 rather, 91 cents versus $5.71 of EPS in 2023. So once again, ticketing platform StubHub Holdings set to file for an IPO.
Kind of interesting, right? IPO and willingness to go to market. We talked about CoreWeave, right, yesterday. That ability or willingness, and we'll see what kind of receptions follow, but that's a good or important market indicator, so something we keep a watch on. Hey, we have talked about some big global macro issues. We've talked to a lot of folks in the C-suite here on Business Week on this Friday edition. We've talked a lot about supply chains, and there is some news in the complicated, as you know, but exciting world of supply chains today. We love to follow supply chains logistics. U.S. officials, Tim talked about this earlier, have asked Italian producers if they can help secure egg supplies amid shortages and upcoming holidays, including Easter and Passover. I don't know about you, Tim, but I grew up, taking eggs and dyeing them and coloring them, and it's an important part of the holiday.
Yeah, we'll see if they're plastic this year or if they're real eggs. Also next week, the supplier chain relationships of Dollar Tree will be in focus when the company reports earnings. Supply chains coming under increased focus given the tariff back and forth at the White House. Remember, fresh U.S. tariffs are set to land on April 2nd. Jeremy Jansen watches supply chains closely. He's managing director of supply chain finance at Wells Fargo. He joins us from Atlanta. Jeremy, I want to start big picture. Somebody might hear supply chain finance in Wells Fargo and think, what the heck is Wells Fargo doing with supply chains? So what do you and your team do?
Yeah, sure. Thanks, and thanks for having me, guys. It's a pleasure to be here. So quite simply, we provide working capital and supply chain financing to Wells Fargo commercial clients. We establish traditional supply chain financing programs between buyers and their suppliers. And we also provide standby letters of credit, import-export letters of credit, and very traditional trade finance type products.
So interesting. All right, so tell us what you are seeing in particular when it comes to the supply chain narrative. We've talked a lot about it just in today's edition because we've been talking to folks from the C-suite who are dealing with some of those issues. And so what are you seeing? Are companies making changes? Were they already, from our understanding, they were already making changes coming off of COVID. But what can you tell us in terms of the macro and the narrative here?
Yeah, so thanks, Carol. I think first thing I'd like to say is fundamentally the supply chain itself, logistically, remains very healthy. When you look at key indicators, shipping costs, port congestion, port job vacancies, inventory to sales ratios, all those dials in the cockpit are still at a really nice level, and to your point, somewhat at pre-COVID levels. But the U.S. trade policy, it could remain dynamic for quite some time, and how are businesses reacting to this? Many management teams that we speak to are taking somewhat of a wait-and-see posture publicly, but behind the scenes, in closed doors, they're working out many different scenarios. As you also mentioned, this is not the first time our clients have been here. In 2018 and 2019, with tariffs that came in at that time, they built some playbooks, right? So they have a pretty good roadmap on how to navigate this.
Is this different though, Jeremy, because we're sort of going global, or the Trump administration seems to be going global? We'll kind of find out all the details on April 2nd, which he calls Liberation Day. But is this a little different?
It's a little too soon to tell from my perspective. Okay. I don't want to speculate, but certainly the discussions are very similar, right? And our clients do have a pretty strong playbook and a pretty strong roadmap on how to handle this. Perhaps it's a two-way share between the supplier and the importer. Perhaps it's a three-way share between the supplier, the importer, and the customer. We're seeing all of those strategies play out, again, behind closed doors and even publicly, right? You're starting to see some companies come out and talk about the impacts that it could have on their costs for the year, or maybe give some glimmer of how they may pass that through onto the consumer.
Yeah, it's certainly important issues as we continue to track all of the companies, certainly the publicly held, and something that we continue to look for when they are reporting earnings, and will continue to do so, what they have to say about it. Hey, listen, thank you so much, Jeremy. Important angle, certainly one that we're covering here at Bloomberg. Jeremy Jansen, as we mentioned, he watches supply chains very closely, Managing Director of Supply Chain Finance over at Wells Fargo, joining us from Atlanta on this Friday. Hey, Tim, we are still right across the screen, down about 1/3% on the S&P 500, down about 1/4% on the Dow Jones Industrial Average, and the NASDAQ 100 down 0.2%. Carol Massar, Tim Stedovic. This is Bloomberg.
3:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story, and traders are going short the dollar for the first time since before President Trump's win. Let's head right over to the first word breaking news desk for today's afternoon call, and here he is, Bill Maloney.
Good afternoon, Charlie. U.S. stocks are off the lows, but still in the red right now. The Dow currently down 113 points. The S&Ps are down 22, while NASDAQ is off by 0.1%. The U.S. 10-year yield is at 4.24%. Gold is in the red, oil is in the green, and Bitcoin, that's down by 0.5%. Among the main 11 S&P sectors, only telecom and consumer discretionary were in the green. Materials were under pressure, and leaders to the upside in the Dow, Boeing and J.P. Morgan, while Nike fell 6% after earnings and led to the downside. Also after earnings, FedEx fell 7%, and in deal news, Clear Lake is said to be near a deal to buy Dun & Bradstreet for about $9 a share. In other news, Boeing won the next generation fighter jet contract, and wrapping things up, StubHub files for an IPO. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill Maloney. And within 19 minutes to go ahead of the close, we do have the S&P 500 index on track for a weekly win by 0.03%. To hear live breaking news over your Bloomberg, type SQUAWK, SQUA, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on.
Excuse me, I want to drive. It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. Coming up on 18 minutes to go to wrap up the trade. We are definitely holding on to our better levels of the session. We were down a lot more earlier on. You just heard Charlie and Bill Maloney breaking it all down. We'll see if it holds, whether or not we see some selling into the close here. We do have some expirations, and so in terms of options, so whether or not that will be a factor. But nonetheless, holding on some gains. So let's get to it. It's been another full week, to say the least. Marta Norton is Chief Investment Strategist at Empower, joining us from Chicago. Hey, Marta, good to have you here with Tim and myself. We are so familiar with your company. You guys administer the Bloomberg 401k plan. We like to be transparent.
Carol, you've been talking a lot about your 401k this week.
It's been kind of terrifying, and I have to be honest with you. I was looking at making some changes a little while ago because we've all been talking about the European markets doing so much better. You guys, though, are the second largest retirement plan provider in the United States. Talk to us about what your role is and what you see to get an idea of what's on the minds of investors and what's going on.
Yeah, sure. So my role at Empower, and of course Empower has that retirement business. It also has a wealth business. And so my goal is to really formulate that markets and economic point of view across both our retirement business, our wealth business, and provide that perspective to our clients and to financial media. And I think one of the things that, of course, is top of mind, and you've kind of alluded to it already, is this idea of whether we're going to see some sort of capitulation in how investors are positioned, and of course that ever important retirement investor. And I think at this point, we've had that technical correction in the S&P 500, and I think you see a little bit of pickup of nerves, I guess I would say, in the retirement space, but not massive shifts in terms of how people are positioned. So you see some movement on the margin, but nothing that would suggest that investors are, frantically moving things around in their retirement accounts.
Marta, it looks like in the notes that our producer Paul Brennan sent us, you argue that the market's not fully understanding the extent of tariffs. What do you mean by that?
Well, and this is, we're doing scenario analysis here, of course, and the future
Okay.
is uncertain. There's a range of outcomes here. But I think when you take a look at what the tariffs could look like, immediately, in 2025, as we saw those initial forays with Canada and Mexico, the general narrative was that those were largely negotiating tactics. And I think there's good reason to think that there's a certain level of negotiation when it comes to a lot of this tariff talk. But when you look at the broader picture of what President Trump has talked about, both on the campaign trail and more recently when it comes to tariffs, he's focusing on raising revenue for the federal government. He talks about establishing a U.S. manufacturing base. He talks about trade deficit. And I think as you look at those objectives, you have to entertain the notion that tariffs could be both broad-based and long-lasting. And the market, I think, has begun to grapple with that idea, but I don't know if it's really come in full force. When you think about what that impact could be, both on the costs, on companies' businesses, and then potentially from a retaliatory perspective on the revenue. And I say that especially because where we look at where valuations are, earnings expectations, it just doesn't look like there's been a massive recalibration.
Can I ask you, is it really hard to figure out what's next for the markets? I mean, even Bill Dudley, formerly of the New York Fed, was kind of saying it's really hard for the Fed, the U.S. Central Bank, to kind of figure out the outlook right now, kind of flying blind at this point. So it's kind of hard right now, isn't it? I mean, I feel like we could either really recover if certain policies come out of Washington that'll be really supportive to business and to the markets and to investors. And then there are policies that, if they stick, will not be. How difficult is it to predict right now?
Well, I think if there was one word, and of course I didn't do kind of a word count with Powell's comments, but if there was one word that jumped out over and over again, it was that theme of uncertainty. So we heard that from Powell as he talked about, certainly there was a directionality in the summary of economic projections, growth coming down, unemployment edging up, inflation edging up at least for 2025. So you had that directionality, but there was this real sense of uncertainty there. And then you see that in the economic policy uncertainty index, you see it in consumer sentiment, you have a little bit of a read from businesses in that regard. So I think there's really been, coming out of Washington, this fiscal directional switch on a lot of different policies, from regulation to, taxes, to immigration. And then within trade, of course, maybe not a directional shift, but a magnitude shift. And so trying to understand how that plays out and what the market implications are, I think is pretty meaningful. Now, I think as we look back at kind of where are we starting from a foundational level, there's a few things we know. We know the economy is cooling, but is still generally strong, and we know valuations are high. So that gives us a little bit of sense as to how to take everything in. But yeah, you're right. I think it's maybe trickier than usual.
Well, what would change your mind? Like, what would make you less cautious? Because you do seem cautious. You say this isn't necessarily a buy the dip moment unless investors were on the sidelines with, overweight cash, or they were, underexposed to equities, is perhaps another way to say it. What would make you change your mind and say, okay, now I'm feeling more comfortable about getting into this market?
Well, there's a few things. I think if we had greater certainty on the policy front as it comes to tariffs, I think that would be helpful. I think also if we were to see valuations look a little bit more attractive, sometimes I think people focus a lot on price movement to determine, those buy the dip moments. But I think you really want to look beyond price movement to where valuations actually sit. And as you get those on your side, then you can have a little bit more of a margin of safety and expect maybe a better, 3-year outlook when it comes to returns. So having valuations on your side, getting clarity on a policy standpoint, I think that would help. But I'm not, as I certainly am cautious, but I want to clarify that I'm not necessarily calling for, a recession in that ilk. I think that we can see a growth slowdown, certainly as uncertainty picks up alongside the fact that we were already seeing some cooling in the market. But I don't know if that would necessarily tip us into a recession. So I think there's news that we have to navigate, but I don't know if we should put our head in our hands and cry in a corner.
All right, we're going to have to leave it there. Hey, listen, thank you so much. I'm glad to hear that.
No crying yet, Carol.
Or have a glass of wine or two on the weekend. Marta Norton, she's Chief Investment Strategist at Empower, joining us from Chicago. Marta, thanks so much. Do you have a headline crossing the Bloomberg terminal? The Biden administration secretly permitted Chevron to pay hundreds of millions of dollars to the Venezuelan government despite a license that explicitly prohibited such disbursements. Tim, this is according to people familiar.
Yeah, this supplement to a November 2022 sanctions waiver allowed Chevron to remain in compliance with U.S. law while paying the regime of President Nicolas Maduro taxes and oil royalties, said the people asked not to be identified, discussing non-public information. The initial waiver from the Treasury Department's Office of Foreign Assets Control granted Chevron permission, Carol, to conduct limited operations in the Latin American nation. Check out more on the Bloomberg terminal.
Yeah, and safe to say this arrangement has drawn some scrutiny. Critics arguing that Chevron's payments are supporting the Maduro regime. The administration is now requiring Chevron to wind down its Venezuelan operations. All right, folks, we're just about 10 minutes away from the close.
Listening to Bloomberg Business Week with Carol Nasser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we are just about 7 minutes away from the closing bell on this Friday, getting ready to wrap up the trading day and, of course, the week overall. And it's been quite a busy week. And it was a day, though, that started with our focus, certainly for those of us here in the U.S. waking up, what was going on over in London, Tim?
Yeah, so it was around 1 a.m. when, according to a couple people that our own Nick Bartlett and Hema Parmar interviewed, when a pilot informed passengers that the plane that they were on would be turning around and returning to Toronto because London Heathrow had been temporarily shut down. What's more, the captain added the flight would make an unscheduled stop in Goose Bay, Canada.
Well,
Puzzled. Yeah, go ahead.
No, you go ahead. You're telling it so well.
What is Goose Bay? That's what they all want to know.
Could you wake up and you're like, wait, what? Where are we going? Has that ever happened to you? Have you ever been on a flight? I'm trying to think if I've ever been on a flight where all of a sudden
I'm always, when I'm on an airplane, I'm always listening to make sure I'm on the right one.
Yeah.
Because, you don't want to get on a plane and end up somewhere else. Like, I think that happened in Home Alone 2 or something. I don't know. So, Goose Bay, it turns out, sits on a military base in Canada's far eastern province of Newfoundland and Labrador. The plane needed to refuel there before then returning to Toronto, adding time and an unusual twist to this wayward journey.
Yeah, listen, I mean, this sudden change of plans we know was repeated over and over again on dozens of commercial aircraft, thousands of miles apart in the wee hours of this morning as planes had to divert or turn around after that fire broke out at a power station near London Heathrow. The mishap throwing one of the world's busiest airports into disarray, cutting off electricity and forcing it to close. Paul Sweeney was kind of funny on Bloomberg Intelligence. He's like, okay, if I got stuck where I left Heathrow, went back to London, he's like, I'd get on the train, take the channel,
I heard him say this,
go
yeah.
over to France, and then get a flight home from Paris. Like, have a croissant, have a good meal in Paris, and then go home from there.
Kind of makes sense. I mean, yeah, take the channel, you know.
Yeah.
Get from London to Paris. It doesn't take very long. It's easy to do.
Yeah.
Carol, we did get news, though, that flights are set to resume today, if they haven't resumed already. This was due to this fire that really sent this airport into disarray, cut off electricity, and forced it to close.
Yeah, no, I mean, it's pretty dramatic, right? Like, you realize we've seen this with crazy weather. We've seen this with climate change. We've seen it with fires, different reasons, certainly weather in general, just where all of a sudden a major hub and certainly an airport can be shut down. And because of connections and flights and, you know, you can't just start it up. You've got to make sure everything's in place, especially in terms of where the planes are going. So it's going to, you know, good to hear that it's back up and running, and hopefully, you know, through the weekend and hopefully by Monday things are back to normal. But it's kind of tricky. I mean, I can't even manage. This couple says 19 hours after initial takeoff, it's the Sethi family, returned to their home in Toronto. They once lived in London. They were planning to go see, you know, a couple of shows there, spent a couple of weeks on holiday. They're now waiting further details about the rebooked flights Air Canada has promised its passengers. Their immediate plans were to take a shower, go home, do some shopping, head for the gym, going to do some squats.
Okay. Well, I keep checking, you know, my flight status to see if, you know, this stuff has ripple effects throughout the world, right? Because, you know, planes coming from one place then go to another place. So it can wreak havoc on the global travel system. So far, though, Carol, I am set to return to New York just after our show today.
Thank God, because we just need you back here. I'm just going to say that. I mean,
that's what I hear from the home front, too, interestingly enough.
Oh, I bet your wife's going to be like, hey, honey, glad you're home. Here are the kids. I'll see you later. That's what I would do if I was your wife. All right.
You can read her mind.
Yeah. No, listen, I get it. Have a safe trip home, but don't go anywhere because we got to wrap up the trading day. We got to wrap up the trading week. It's certainly been a full one. Just a reminder, folks, of where we are with just a few minutes to go. We're up now, actually in the green. Some buying in the close, up 2 points on the S&P and the NASDAQ 100, up 56. That just happened in just a couple of minutes. All right, heading over to our TV colleagues. Closing bell start right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Alex Steele, Scarlet Fu, taking you through the Closing Bell in a global simulcast. We're joined now by Carol Masser and Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day, which today, guys, is options expiring and the volatility around the closing bell.
I was just going to say the most interested is really kind of what's just happening in the last couple of minutes. Tim and I were just talking about a different story going back and forth. The market was in the red when we started. When we looked again, all of a sudden we see some slight gains here, Tim, on the major equity averages.
But I actually think this is important, at least according to one superlative, because had we stayed in the red today and had a down week on the S&P 500 and on the NASDAQ 100, it would be 5 straight weeks of decline for those two indices. It'd be the longest losing streak going all the way back to May of 2022. And that was quite a while ago.
Yeah, we broke the streak, so it does feel like maybe we might have reached the bottom for now. No one's saying that we're off to the races yet. We could be in this rolling recovery for a number of months. Everyone's saying it's going to be a rocky first half and things will start to settle down in the second half of the year.
Well, also, if you look at kind of what is outperforming like technology, that was what was beaten up the most. So then do you look at it as more of a short covering and positioning versus any sort of change in the macro environment?
Yeah, listen, when it comes to the macro, I feel like there's one word that we care about, and that's tariffs, whether or not we're going to see, more in terms of coming out of the White House. So that's one of the things I'm thinking a lot about right now.
All right, we're cheering. We're getting there. Closing bell, real close. We made it through this week on a definite up note. We're taking a look at the S&P, still settling out, but looks to end relatively flat on the day. Same thing with the Dow Jones Industrial Average. The NASDAQ outperforming, like I mentioned, up by about 0.5%. And just take a look at the Russell 2000 to see if that rally has spread a little bit. Not so much. The Russell's actually down by 0.5%. So it's not a very generous rally. It is still tech-driven.
Yeah, right, exactly. S&P 500, guys, 349 names losing ground in the Friday session, 154, Scarlett, to the upside.
And as Alex mentioned, big cap tech really driving some of the advances today, this late rally. And you see that reflected in the IMAP. The biggest sectors that are in the green, mainly the only ones, are communication services, consumer discretionary, and infotech. Those are where the Mag 7 names live. Everything else is in the red. In fact, real estate down 1%, materials down 1%, utilities off by 2/3%.
All right, a lot of red there. No, actually, a lot of green. Well, kind of a mixed bag, but a little bit more green there. Hey,
green by weight, red by number of sectors.
Thank you very much. Good. Hey, listen, in terms of individual gainers, Boeing on that list, it was up as much as 6% at its highs today, finishing with a 3% gain. It was among the top gainers in the S&P 500. The company winning a contract to design and build the U.S.'s next generation fighter jet, beating out rival Lockheed Martin for what is a multi-billion-dollar program. We did see the president announce that decision earlier today at the White House along the U.S. Defense Secretary. All right, Tesla, also number 2 gainer in the S&P 500. I believe it's the number 1 gainer here at the close in the NASDAQ 100. Couple things going on. Elon did hold an all-hands meeting to reassure Tesla employees about the company's shares plummeting over 50% in the last 3 months. He reiterated his claim that Teslas will soon be capable of driving autonomously with a software update. He also mentioned the launch of a new, more affordable model in the first half of the year. He offered little detail, though, about those vehicles. I do also want to point out, too, that retail investors seem to be individual investors buying a lot of Tesla shares for 13 straight sessions, pumping about $8 billion into the stock, despite the stock heading lower. So a few dynamics going on there. And then I'm just going to be really quick with this one. Luminar Technologies, something different. It's a small cap, micro cap company, up about 32% here. It makes sensors for automobiles, posted fourth quarter revenue that topped estimates, and provided guidance for this year, including guidance for revenue growth of as much as 20%. Keep in mind, about 33% of the float is shorted, but nonetheless, super outperformance. And again, it's a micro cap.
Okay, a few stocks that we've been talking about quite a bit today. Important ones to note for their declines. Nike shares falling by 5.5%. The company did say it expects revenue and profitability to decline further. Gross margins dropping sharply in the current quarter. This due to U.S. tariffs on products from China and Mexico. Some questions about Nike's turnaround efforts and the challenges there because of inventory clearance and the impact of the growing trade war. Nike shares down 5.5%. FedEx also down after reporting earnings after the bell yesterday, 6.5% to the downside. The company lowered its full-year guidance for the 3rd consecutive quarter. It cited inflation and uncertain demand for shipments. The latest outlook assumes the global economic, political, and trade environment doesn't worsen any further, and that it's making progress on its plan to spin off its freight division as a separate publicly traded company. And you heard Carol talk about Boeing as one of the gainers today because of that award from the White House. Lockheed Martin down 5.8%. This after Boeing won that contract to design and build the U.S.'s next generation fighter jet. This award caps more than 2 years of competition between the defense giants for the full-scale development of the next-gen air dominance manned fighter. It's going to replace the F-22 Raptor. It's envisioned to operate alongside drones. Those are being developed, though, as part of a separate program. Once again, Lockheed shares down 5.8%.
It's a very dramatic move. I feel like it's also broader uncertainty, obviously, in terms of money as well. All right, bond market. Snooze fest. It was also whippy around the equity market as well. So at one point we saw some nice buying as equities were selling off. Obviously that reversed with the long end selling off a little bit. And just for your preview, $108 worth of issuance comes next week in 2 and 5 and 7-year notes. So put it on your calendar.
All right, we certainly will. Hey, one of the things that was certainly of note today, we did see FCC Chair Brendan Carr making some comments and interviews about how it is getting ready or prepared to block M&A deals and proposals from companies that promote invidious, that was his word, DEI policies. Well, another story related, or that at least caught our attention, JP Morgan renaming its DEI program to DOI following political backlash. And so rather than diversity, equity, and inclusion, it now stands for diversity, opportunity, and inclusion, Tim.
Okay, so Jen Piepsack saying, she's COO, she said that in a memo to staff that it's because the E always meant equal opportunity to us, not equal outcomes, and we believe it more accurately reflects our ongoing approach to reach the most customers and clients to grow our business. It does raise the question, though, about what companies are doing in the face of all this criticism, not just from the Trump administration, but from outside groups as well. Because it looks like there could be serious consequences for companies that do have DEI policies. If a company does want to still keep these policies in place, do they just change the name? Do they change the meaning of them? I think there are a lot of questions here still.
Or they dismantle the most obvious parts of their infrastructure and continue to, enact not policies, but customs maybe that go with what they had planned. It's an open question. It's all open to interpretation. And that's the thing. When you remove the infrastructure, it all depends on personnel, doesn't it?
Well, also, I guess the question is it just the language and the framing, but the internal policies and external policies may be the same way that there were still sort of inclusive ways that companies were looking to deal with vendors, for example. They wanted to have diversity within vendors. That was already there. It was just the language and how it was used was a little bit different. And is that the part that's changing?
Well, no one's going to come on TV to talk about it, that's for sure.
I will say they did say that their employee groups are going to continue to focus on engagement, cultural celebrations, education, historical observances, and they plan to reduce trainings while maintaining a focus on high-quality offerings, at least according to their memo. So I guess we'll wait to hear a little bit more about that as well.
The other story that caught my eye, and I don't know if any of you have gone to London recently.
Not today.
Not today.
I don't think anyone.
A lot of people did.
Really tried, who were trying to get there, got there.
Yeah, well, that's a good point. But in general, it's become Europe's mobile phone theft capital of the world, or at least within that region. 70,095 recorded thefts in a year. A lot of people on electric bikes will zoom by and take your phone, and they can sell it on the black market or the gray market for like $1,500.
But is it like in your bag or like in your hand? And
You're
they get
on
it?
your phone, you're kind of looking at it, you're not paying attention, and someone grabs it.
But I thought like the whole, anti-theft stuff that phones have where it's like auto-locking, you have to have Face ID and, control of, I thought these things you could lock them remotely and just not even allow, and that deterred thefts. That's obviously not working.
Yeah, but you could strip it for parts. Break it apart and sell the stuff inside.
Ooh, apparently Westminster, guys.
Sounds like you know what you're doing, Scarlett.
She does. It's her side gig.
I've just read a lot of stuff.
But guys,
Keep
Westminster.
Keep my phone away from you.
The Westminster, where it has like all the high-end shopping, right, and the entertainment areas, that's apparently the worst area where you have the most phone thefts.
I will say my daughter spent a year over there going to school, and she was like, don't leave your phone out. Don't be so on it. So there was a little bit of a warning when we were overseas a little bit. So
you need one of those things, like the fanny pack, but for your phone.
Yeah, or maybe get off our phones.
Yeah, don't walk and look at your phone at the same time.
Some people were just busy, okay? Spelling bee doesn't work on its own, all right? You got to put some effort into that.
Guilty as charged. All right, guys, have a great weekend. That is a wrap. Our cross-platform radio, TV, YouTube, and Bloomberg Originals. We call it Beyond the Bell. We'll see you again. Actually, don't we call it the closing bell? I don't know. We change it sometimes. Anyway, thank God it's Friday. I will see you guys on Monday. We will see you on Monday.
This is Bloomberg Business Week, insight from the reporters and editors that bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, everybody, this is Bloomberg Business Week. Carol Masser here in New York headquarters at Bloomberg. And, of course, Tim is out there at our San Francisco bureau out on the West Coast. Another busy week. We say it again, but let's just remind everybody we had a Fed meeting. We had a press conference from Jay Powell that we kind of went through every word that he said, a nonstop flow of comments and developments out of the White House, including most recently the dismantling of the Department of Education, and a bit of a choppy week that barely ended in the green for the S&P 500, but significant significant because we've had several consecutive weeks of down weeks, but not this week for the S&P. Just some of the backdrop for tonight's episode of Bloomberg Wall Street Week with David Weston that continues to look into the longer-term trends that are impacting our world. David, of course, is host of Wall Street Week, and it comes your way at 6 p.m. Wall Street time on radio and TV. He joins us in our Bloomberg Interactive Brokers studio. Yeah, a lot coming at us, right? That's just kind of the way of the world. You did catch up with Larry Summers, which is always so important when it comes to a Fed meeting where we're thinking about inflation, the economy, and also when the word transitory comes up, but in a different way, at least from Jay Powell.
Exactly, and start exactly there with the Fed meeting, what Larry had to say about that. He observed what we all observed, which is, inflation up, growth down.
Not good.
Not good. And certainly, uncertainty definitely up. I mean, Jay Powell said that again and again and again. And he said, look, things have deteriorated significantly economically in the last 2 months. And he said it's all because of the White House, and particularly the tariffs. He attributes it all to that. That's Larry's point of view, at least. Now, he's served under Democratic administrations, but he says he really sees it deteriorating because of the tariffs. It's really a big problem.
I am curious, does he think, I feel like so many people think that because this is a transactional president, or that's how he's described, that this is just strategy and that things don't stay there. Does he believe that, or does he think that this is a president who believes in tariff policy and is going to kind of keep them there?
I think he doesn't know. I mean, Larry says, look, it could go another way. All he can say is where it's going right now. And he certainly sees that. He also commented, he really seized on something I hadn't really focused on. I'd focused on the fact that the quantitative tightening they backed off of sooner than they thought they would. And I thought that was they wanted more liquidity because they were concerned about if something goes south in the markets, they have liquidity. He said it's actually terming in the debt. But that is actually the government saying, you know what, we think we have trouble getting the long-term debt placed. We don't want to put too much stress on it. He said that's a bad thing. That's sort of bond vigilantes around the corner. He's trying to anticipate that. He said you got to pay attention. He thinks people underappreciated that decision as terming in the debt. So, but in addition to that, we also talked to him about what the White House is doing with respect to appointments, particularly the two FTC commissioners, as you know. President Trump dismissed two democratically appointed FTC commissioners, and we asked him about that and what he thought that might mean more broadly. And Larry actually was pretty stirred up. This is what he had to say about where he thinks we're headed. Not there yet, but headed. This is what he said.
We are not there yet, but every week for the last 2 months, the risk of an attempt to impose authoritarianism in the United States have gone up. It takes decades to grow a forest and a few minutes to burn it down. Something like that is true with respect to our nation's credibility and commitment to rule of law. And so I do not remember in the last 50 years a more alarming moment.
Yeah, and now you heard him say we're not there yet.
Right.
But he sees it at least that we're getting closer to that point. And particularly that has to do with the president taking specific actions and disregarding Supreme Court decisions. We're not there yet. But if it happened, and you heard him refer to the rule of law, because Larry always comes back to, in terms of economics and in terms of business.
Right.
If we do shake the rule of law, it really has effects on treasuries and on the entire market that he keeps warning us about.
And business confidence, whether or not businesses are willing to do anything or get stuck. Tim, come on in on the conversation.
Hey, David, he did mention that, it has only been 2 months, and so far, this much has already happened. I mean, we got, more than 3 years left of this administration. Does he think that the courts are a last backstop to some of the changes that he fears?
Yes, listen, obviously the courts are terribly important, and he would be the last person to say he's going to say exactly how the Supreme Court rules in the attempt to overturn Humphrey's executor, right? That's not his bailiwick. But it seems to me that there are two possible guardrails here in the end, and one of them, I think, are the courts. You saw Chief Justice Roberts come out this week and talk about the remarks from President Trump about impeaching a judge because he ruled the wrong way. But the other one is the markets, and it takes us back a little bit to terming in the debt. I think that Larry believes that the markets at some point will react. But when and this is just Larry Summers talking, this is his point of view, but he really made sort of an impassioned plea to the business community to say, you really have to be talking to the White House about this, about how severe the consequences could be. And he definitely thinks there's a bigger risk today than he thought there was 2 months ago. I mean, there was always kind of an issue, sort of a question, but now he said, no, this is the actions they've taken actually move in the wrong direction.
Hey, David, you got a big program coming up. It's not just your conversation with Larry tonight. I wanted to jump ahead a little bit to give people a little preview. Just because I'm out here in San Francisco, my hotel is actually right by the Transamerica Pyramid, and I walk by it each day on my way back to the hotel from the office, and I see the word Chavot on the outside of it.
He owns it, right?
Michael Chavot. Yeah, we've interviewed him a bit over the past couple of years. He plays a role in tonight's episode.
Yeah, he does. What we did is, it's a little bit cutesy, but I think it's relevant, particularly talking about DEI that you were talking about earlier.
Yeah.
3 bandwagons that everybody jumped on, and now they seem to be trying to get off. One is DEI, one is EVs, and the other is the move to Miami. If you remember, back in 2020, 2021, we were basically going to empty out New York. We were all going to move to Miami. People have backed off that. And we talked to him about that because he's got investments down in Miami as well, and in San Francisco, and in New York. And really what led to that, he thinks it was always overhyped. He always thinks that we over-reported that possibility, but clearly people have backed off. Doesn't mean they don't like Miami, won't move to Miami, but there were some structural problems, particularly with the schools. And to some extent the infrastructure in Miami that cooled off a lot of the brave announcements by some of the companies who said they were going to move all their people down there.
Well, speaking of real estate, you guys also take a look at DC real estate tonight.
Yeah, our colleague David Gura came in and interviewed some real estate people in DC because we've been covering real estate in New York and San Francisco, to some extent Chicago. But actually, a viewer had written in and said, what's going on in DC given what's going on with the Trump administration? Right. And it's sort of the two tales. On the one hand, you've got some people with a lot of money going in and spending an awful lot of money on huge houses right now in D.C. So the upper end of the D.C. real estate, boy, it's really going gangbusters. On the other hand, there are a lot of people who have either lost their jobs or are worried about losing their jobs. Right. And so in the middle and the lower end, actually, there's a lot more stress. So David takes us through exactly what's going on in D.C. in real estate.
I am curious, because you're traveling, your team is traveling around and getting kind of checking the pulse, I think, of different industries and different folks around the nation. And here we are, we're talking more about recession, which we hadn't been talking maybe a month ago or so. Are you feeling a more negative outlook or a positive outlook in terms of what's going? Can you get a feel?
Well, I mean, just from the people I talk to, which doesn't make it scientific at all, it's uncertainty. It's exactly what we heard from Jay Powell. I think it's too simple to say it's negative. It's not positive. And as I think Larry said, it's worse than it was a couple months ago, the sentiment now.
Right.
And Jay Powell talked about that, the sentiment numbers, the UMich and other numbers, actually. He dismissed UMich as being an outlier. And in fact, it's not, if you looked at other numbers. But on recession, I think it's probably too soon to say we're there, but certainly a lot of uncertainty. I talked to John Gray yesterday at the Economic Club in New York. And he wants to calm things down and say, look, let's just be patient, and we're long-term investors. But he admits there's a lot of uncertainty out there. Whether it's CEOs or investors, saying, let's just figure out where things are going. It's not the time to commit an awful lot of money, not knowing where we are. Actually, I just got back today from talking to Governor Lamont of Connecticut. He said, imagine the situation if you're a governor trying to put together a budget, because you don't know how much money you're going to get from the federal government. She said, we're going to do a budget, and we may well have to redo it 2 or 3 months down the road.
Yeah, so back to uncertainty.
Yeah, back to uncertainty, exactly.
All right. Good stuff, David, as always. Thank you so much. David Weston, host of Bloomberg Wall Street Week on Bloomberg TV and radio, coming your way at 6 p.m. Wall Street time. This is Bloomberg.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg after 4 down weeks. An up week for the S&P 500 index and this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Again on the week, S&P 500 index this week up 0.5% after 4 weeks of losses. A rally in several big tech spurred a rebound in stocks after a sell-off driven by disappointing outlooks from economic bellwethers across various industries. Case in point, both Nike, Micron, and also FedEx. Today, the S&P 500 index ended higher. Late day buying up 4 points, 56.67. That was a gain of 0.1%. The Dow today also up 0.1%. NASDAQ up by 0.5%. 10-year 4.24%. The 2-year 3.94%. Gold down 0.8%. 3,021 the ounce. And West Texas Intermediate crude up 0.3%. 68.29 a barrel. Boeing has won a contract to design and build the U.S.'s next generation stealth fighter jet, beating out rival Lockheed Martin. Boeing today up 3.1%. Lockheed Martin down by 5.8%. And sources tell Bloomberg the Biden administration secretly permitted Chevron to pay hundreds of millions of dollars to the Venezuelan government, despite a license that explicitly prohibited such disbursements. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you so much for that update, Charlie Pellet. Really do appreciate it. Well, we've gotten some various reads on the consumer thanks to recent reports from Nike, Carnival, and the U.S. airlines. We're also going to get a read when the banks report in the coming weeks. So what about a view from a small business? Candace Softy is the founder and CEO of Snoga Athletics. She joins us in New York in the Bloomberg Interactive Brokers studio. Candace, welcome. We do want to get your read on the consumer, on the market. But first, Snoga makes what you describe as modest activewear. Define it. What exactly is it?
So I created about 20 years ago out of high school a skirt with an attached legging. So the skirt comes to about the knee, sometimes a couple inches above, for any woman who's looking to be a little bit more covered in the gym.
Why did you think we needed to do that? Although I kind of love the idea, but go ahead.
So it all started literally 20 years ago, right when I graduated high school. Yeah. I decided for religious reasons I was going to start wearing skirts. Nothing was out there. There was no Instagram, no Facebook. And I created the first sample. I actually worked for my father at the time, who was in the clothing manufacturing business. And I created the sample for myself, sold it door to door. There was some interest. And I figured if I needed it, someone else must need it. But the world wasn't as small back then because of, the lack of social media.
So I wonder about the, what was happening at that time, because I feel like that was like pre-athleisure at that time.
It definitely was. There was nothing out there.
Yeah, so since then, I mean, athleisure has just taken off. So you were early to something. You saw something early. What has happened to this market since you entered it? I mean, it seems like it's become so much more competitive.
Yes, and we actually created a category, honestly. When we started back when I was 19, so a little less than 20 years ago, when I started the business, we were selling door to door. I had a couple kids. I stopped for a few years, and then I ended up partnering with my mother and my husband. We're now a family business, and we grew the line from one style now to about 30 different styles. And yes, we just molded in with the rest of the world, melted in with the rest of the world of athleisure. So we didn't look at it like athleisure at the time. We looked at it like exercise clothing, but now the word is athleisure, and that's what we're doing.
It's so funny. I was thinking about it in prep for this segment, and I think there was something either I read in the Times, and it was like, or something on social, about there's like a little bit of a debate between like tight, athleisure wear at the gym versus stuff that's a little bit more baggy. And I do feel like it is evolving. You think about, though, as you said, you wanted to wear like a skirt or something, like you were thinking about wearing skirts.
Yes.
But there are different cultures and people who work out, but still want this kind of, wardrobe and clothes to wear. And it sounds like that's really part of what you were thinking and the mission.
Yes, so that's pretty much the whole story. I was just saying, as a kid, I was watching an Oprah episode, and there was a Muslim lady who was a trainer, and she was explaining in the interview that she used to wear a baggy long T-shirt because she couldn't find anything that would suit her working out. I was a kid at the time, so obviously that stayed in the back of my head. Now, fast forward years later, when I was in the same position, I couldn't believe how many women fall under the same umbrella with wanting this. And now, 10 years officially into this business, it's more than just religious reasons. There's women that just, either their age or they just don't feel comfortable in a legging alone.
Right, exactly.
Is it all direct to consumer, or what's your distribution?
Yeah, so the majority of our company is, yes, our website. And we're on Amazon, we're in boutiques around the country.
Where do you see the biggest driver of traffic?
Is our website is our main driver of traffic, yes.
More so than Amazon?
Much more.
And do you prefer people buy directly from you rather than through Amazon?
Definitely.
Is it more expensive to, okay,
Definitely,
interesting.
yes, because our customer service is our main part of how we started and wanted to separate ourselves with every other, well, there wasn't really any other company, now there is, but that's a main part of our business is, making our customers happy, bringing them back.
Well, and I love it that, it's for women, but it's also for girls. So you're thinking about, a younger generation who probably have the same needs, demands, or wants,
Exactly,
right?
and we sell little girls now also.
Yeah. So, okay, we are Bloomberg. You've been doing this now, you said, for 10 years?
So 10 years, I did start it, and then I stopped it, so I guess officially 10 years.
Officially 10 years. So give us an idea of, the growth of this business, because I do think, certainly coming off the pandemic, let's go there. What was it like working through the pandemic?
It was very interesting. We were very lucky. We got the pandemic hit, the world was shutting down, and our last shipment just slid right in perfect timing before the world was basically crashing down. And we did very well. We did very well during the pandemic.
Did demand ramp up?
Yes, it really did, because people were at home, they were working out at home, people were on their computers more, on their phones more. We were also on social media, on Instagram at the perfect time when that first started. A few years in, so we got the best of Instagram as it first.
Before I toss it, I know Tim wants to jump back in again, but what about supply chains? What was that like during the pandemic? Do you guys manufacture overseas?
We manufacture both overseas and domestically.
You do?
Yes, we do. So we did a little bit of both, and it just, thankfully, it worked out.
What's the cost difference in doing it? Because I think this is something, it's interesting, post-pandemic, we are talking to more and more companies that have multiple supply chains or are growing their supply chains to make sure, and often having a supply chain in the market that they sell. Is there big differences in terms of cost and doing business, an overseas supply chain versus the U.S. supply chain?
There is a cost difference. It's also a little bit easier overseas for certain things, like with trims and things, come out a little bit faster, but we do make it a point to manufacture here also.
Do you plan to move manufacturing completely over here?
We're thinking about doing more of a percentage here, yes.
So Carol was asking about cost, but I mean, is it feasible to actually not import? We talk a lot about what the president wants to see, and that's, manufacturing return here to the U.S., but there are some things that just make it incredibly difficult, namely cost.
Here in New York City, it's not as simple to manufacture activewear as it is maybe somewhere in LA.
Yeah.
But once you set yourself up for that kind of system, which I guess it just ends up working out with the numbers, and you could tweak here and tweak there. Anything's possible.
How do you think about, we, as you would guess, talk a lot about news coming out of Washington and love talking to small business owners, medium-sized business owners. It's so much the backbone of the U.S. economy. We feel like we also talk to, the CEOs of publicly held companies, big companies, and the idea of uncertainty that's out there, not showing what's going to come down in terms of regulations and policies, it's making it tough for, I think, some companies to move forward. Tell us how any of this is impacting your environment.
I think it would be nice to have more support for small businesses. I don't think there is nearly enough support at all. But I think, yes, you do need the small businesses, because now you're finding the small businesses are the ones that are having these ideas, and now the larger companies are buying them. So we have to support the small businesses a lot better than we are now.
Candace, what would you like to see in terms of a specific small business policies? What kind of policies do you think are lacking that would actually help you and others in the small business community?
Well, I just think like opportunities, either if it's it just, I guess it depends on the state you're actually working out of, also with tax benefits and certain opportunities like that. But that's that's a large part of it.
Yeah.
Small businesses can carry certain expenses like that.
Yeah.
And keep going strong.
And it varies certainly, right, from state to state.
Yeah, especially since you're trying to employ local people. You know, you need that support.
Where do you see demand coming from? I know certainly I would imagine New York City is a big market, but where are your big markets?
So our main customer is in the South. That's our
Really?
main, yes, that's our main customer. We have more
Where
of a
in the
conservative
South?
customer. So we do a ton of business in Texas. I mean, it's really everywhere, but a lot of business in Texas. We do a lot of business in Indiana. I'm trying to think of the main places.
Do you know other demographic info about your customers?
Well, our main demographic of our customer would be more of a conservative customer,
right?
In the way they dress, in the way they live. But now, recently, we designed a skirt that's called a perfect pencil skirt that I would compare to the Lululemon men's tech pant for men. So it's a wrinkle-resistant, ribbed, high-performance fabric skirt. That's for the everyday working person. Nothing to do with modest. Not modest. Most women wear. I should say most. There's a lot of women that wear skirts to work, and it's just great. Roll it in a bowl, stick it in your bag. You could actually wear it to the gym if you wanted. You could wear it to skirt to back to work.
I have to tell you, I'd wear this to work.
It's a great skirt.
Oh my God! Wait, which one is it? Wait, I'm looking at it. It's a couple different ones.
It's called our perfect pencil skirt. It has 2 flat pockets in the front, so it's very, very flattering. It looks great on everybody from an extra small all the way to 3X. We're very size inclusive.
Yeah.
And it's an amazing skirt.
And listen, I have often found yoga pants and different things that are they actually look so good that you can wear them. So where do you want to go with this? Give us an idea, and give us an idea how much the business has grown.
So our business grew a nice amount in the past few years.
What's a nice amount? That's not a Bloomberg term.
Doesn't sound like a number.
We were going like 50% for a few years.
Yeah.
And then now it's taking smaller percentages, but it's growing.
But it's also off a larger base, I would assume.
Exactly. It's also, we introduce a lot of new things to the line.
Yeah.
Trying to see what sticks. Our little girls line is doing very well.
I could see that. Yeah.
And we're trying to bring in we brought in this year our weekend wear, our dresses, our skirts, and that's doing well also.
Yeah, it's like you're branching out. Are the dudes going to get anything or nah?
So actually, it's funny. We do get some requests for our bike shorts with actual like a short or legging attached.
Yeah.
But we're focusing now on our little girls and our ladies. There's still a little bit of a hole in the market. So.
Yeah. That totally makes sense. So fun to talk with you.
Thank you.
I truly mean it. Like, we talk to a lot of the large cap companies, always important, but it's really fun to get an idea of what's going on, especially for small businesses, because you continue to do your thing, right?
Yes.
Really good stuff. Candace, thank you so much. Have a great weekend. Candace Safdie, she's founder and CEO of Snoga Athletics, joining us right here in our Bloomberg Interactive Brokers studio. Quick check on how markets ended up on this Friday, folks. We pretty much closed at our best levels of the session. What does that mean? Up about 4 points on the S&P 500, up for the week after several down weeks. The NASDAQ up about 76 points. This is Bloomberg.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks got a late day boost, and for the week, we managed to snap 4 weeks of losses on the week. S&P 500 index had a gain of 0.5%. Today, the Dow, the S&P, NASDAQ all finished higher after spending most of the day in the red. A 4-point gain. S&P heads into the weekend at 56.67, up today by 0.1%. The Dow up 32, also up 0.1%, while the NASDAQ Composite Index was up 92 today, up by 0.5%. But to underscore on the week, the S&P 500 was up 0.5%. Russell 2000 Index of small cap shares, however, finished lower today, down 0.6%. The 10-year 4.24%, with a 2-year at 3.94%. Spot gold down $21 the ounce at $3,023, a drop there of 0.7%. West Texas Intermediate crude up 0.3, 68.30 a barrel, and Bitcoin falling 0.5%, 84,090 on Bitcoin. Lots of concerns for investors, including tariffs and the economic outlook. Marta Norton is Chief Investment Strategist at Empower, and right here on Bloomberg Business Week, she told us, yes, she does see a slowing for the economy, but we will avoid a recession.
I certainly am cautious, but I want to clarify that I'm not necessarily calling for, a recession in that ilk. I think that we can see a growth slowdown, certainly as uncertainty picks up alongside the fact that we were already seeing some cooling in the market. But I don't know if that would necessarily tip us into a recession.
Marta Norton, Chief Investment Strategist at Empower, interviewed right here on Bloomberg Business Week. And indeed, some of the other stories that we're following after earnings today turned out to be a down day for Nike, FedEx, and also Micron Technology. They all reported roughly this time last night. Today, Nike was down 5.5%, FedEx down 6.5%, Micron lower by 8%. Again, up week for the S&P 500 index. Late day buying turned out to be an up day. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. It is today's big take and one of the most read stories on the Bloomberg terminal. A billionaire who made his fortune in cryptocurrency is turning his attention to space. Jed McCaleb is the sole financial backer of Vast Space. It's a startup aiming to build the world's first commercial space station. Here's the company's CEO, Max Holt, in a documentary for Bloomberg Originals.
We are not really a space station company. We're an aspiring space station company until we have a space station on orbit.
So you obviously have an extremely aggressive timeline. How do you make it so that you are launching in just a few years?
We'll be doing it 5 times cheaper and 5 times faster than any other space station that has ever been built. We're investing $1 billion from our investor and founder, Jed McCaleb, to build Haven 1, to win the NASA competition, to replace the ISS.
Kyle Porter has the details of this story. He's North American Industrials and Transit reporter. He joins us from our Chicago bureau. By the way, check out Kyle's story and more from Bloomberg, The Big Take, on the Bloomberg terminal and at bloomberg.com/Big Take. You can also check out that documentary that you just heard a clip from. Kyle, can Vast pull this off? They've got $1 billion behind them, but creating a space station to replace the ISS is no easy feat.
You're exactly right, Tim. I was very skeptical at the outset of reporting this story, but having gone down to see them in LA before Christmas, I've not seen building of that scale anywhere in the world outside of China. It's 24/7, 7 days a week. They're spending the money, and they're pretty bullish on their prospects.
You know, there's this misconception that I think it's fair to say I had before reading your piece, that NASA doesn't really have as much power as it used to. But a point that you and Lauren make in the piece and also in the video is that NASA still controls this awards process. So they might not be doing the manufacturing of this stuff. It might go to SpaceX, it might go to other companies, Boeing, for example, and maybe it'll even go to this company. What is NASA's role in this, in a world where NASA doesn't have the power that it used to?
Well, it's not so much NASA doesn't have the power, it just doesn't do the manufacturing, it doesn't want to. It wants to become much more of a commissioner of projects rather than the developer themselves. And there's upsides and downsides to that. The upside is you're not as beholden to the political cycle for funding. You can have more certainty if you're contracting out to the private sector. The downside is you do lose some of that control, and certainly on a geopolitical level, no one has deregulated the space industry in the way that the Americans have. So it's a little bit of an open question whether it's going to be a good idea or a bad idea.
I guess one of the things, Kyle, I want to know is, who is this dude, Jed McCall? I mean, like, what's his background? Was he just born to do this? Because it sounds like not necessarily you would have assumed that this is what the project he'd be working on.
No, you're exactly right there, Carol. I mean, he's an Arkansas farm boy who said he used to spend his evenings looking up at space as a child. He dropped out of Berkeley. He started his first business in his early 20s. For the elder millennials and Gen Xers listening, it was eDonkey, which was a platform for sharing music. That business folded under a weight of lawsuits, and after a brief period trying to start a Magic the Gathering trading platform, he stumbled into crypto.
And crypto treated him well. He made a lot of money on crypto. He has a background in Ripple, Mt. Gox. What was his crypto story?
Magic the Gathering became Mt. Gox. He repurposed the platform. It became incredibly successful. I think it was the first real Bitcoin trading platform. He sold out. After he'd sold, that platform collapsed and was the biggest ever crypto failure until FTX. He had then started Ripple, left that quite quickly, had a share trading plan which made him billions, and then went on to found Stellar, which combined with Lightyear and is still very active in the industry. And now he's also into AI as well.
So he could take his several billion dollars and create some sort of, I don't know, family office, keep investing, making bets in crypto, making other types of investments, grow that wealth. But instead, he kind of wants to risk what it seems like half of on something that could totally not work out. What's his thinking there?
I spoke to a few people who've worked with him for a long time, and they said you should not think for a second that he's not rational about risk. He's hyper-rational about it. He just has a very firm view on what is the best use of his capital. He's not a guy who's gone to Goldman Sachs or UBS and taken the wealth management plan. The money's his. He spends it where he thinks he can put it to best use.
It was funny, I have to say, when I first picked up your story, Kyle, I thought, okay, Elon's going to hate these people, right? Like, you're invading in my space. No, actually, right? Tesla is lending, or SpaceX, I should say, is lending Vast some technology. There's Teslas in the parking lot, and their CEO actually has a Tesla connection. Like, it's kind of interesting.
Yeah, it is. No company has gotten into bed with SpaceX in the way that Vast has. And that was the one area in reporting where they didn't really want to disclose. They were keen to point out it's very separate. The fact that Vast was, paying SpaceX to send up the Haven 1 shuttle next year, it's like, well, of course, we're a partner and, we're a client. So, it makes sense for us to do these things together. But it certainly gives them a leg up over the competition.
Well, that's where I wanted to go, Kyle. Somebody listening or watching right now might say, wait a second, if these guys have a close relationship with SpaceX, a close relationship with Elon's got a close relationship with Jared Isaacman of NASA and with the president as well, it's a pretty good omen for being selected, maybe?
Look, if you were being completely cynical, and I'm certainly not one of those people, you might suggest that Elon would not cut a program that would benefit his firm financially.
Wait, say that again?
I said if you were being cynical, you would suggest that he would not cut a program that would benefit his company financially.
If you were being cynical.
Yeah, if you were being cynical.
But if you were not being cynical.
Well, okay.
I won't be drawn any further, Karen.
We just have 30 seconds, Kyle. What's the competition that they face in this process?
There's a number of other companies in the space, Axiom, Blue Origin, Voyager, that are all looking to get one of those 2 spots for the ISS replacement. The current plan is for the 2 companies to get taken forward middle of next year. So that's when they're hoping to have the Haven 1 in orbit.
Blue Origin, wait, that's connected to somebody. Who is, yeah, Jeff Bezos.
Yeah, he spends more time in Florida, Carol, than in Washington, D.C. right now. So.
That is very true, very true. And he's not a best buddy. A close buddy, perhaps. A buddy, but not a best buddy. Kyle, great story, great video that goes. We highly recommend you check it out at Bloomberg.com and on the Bloomberg. Kyle is North America Industrials and Transport reporter at Bloomberg News, joining us from Chicago. Do not go anywhere. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, you are listening and watching Bloomberg Business Week on this Friday. Carol Masser along with Tim Stenovec. We're getting ready to wrap up the Friday session. A busy week, a busy day. Let's take a look at some stocks on the move today. And with us is Bloomberg News cross-asset reporter Denitsa Sikova on Friday's Stock Movers. There were, despite what was a kind of funny day again, some significant stocks that stood out, clearly either up or down today. One of the big gainers was Boeing.
For sure. Boeing was the big news of the day, of course, winning the next generation U.S. fighter contract. What we saw initially was 6% jump. Some of those gains faded, so the stock closed still 3% higher. That was actually enough to push it into year-to-date gains instead of year-to-date losses. So that's a small technical thing. What we saw, of course, is we're hearing hundreds of billions of dollars being spent. We're talking about that new 6th-generation fighter jet. President Trump said that this will ensure that the USA continues to dominate the skies. Obviously, this has been ongoing for 2 years. It's a really big deal. And on the other side of the deal, we have Lockheed Martin, which actually had a pretty tough day. They were down nearly 6% on the day.
Because a bummer, right? They didn't get the deal.
They didn't get it. And in 2022, there was another contract which they actually get. So there was some expectations there, but...
I love the defense area, right, Tim? Like, it's always the battle for the contract. And sometimes contracts are split among different companies, and then other times it's like one clear winner and one clear loser.
Well, I was watching this from the Oval Office, President Trump, along with Pete Hegseth, the defense secretary. This secret Boeing plane has been flying for the last 5 years. I was looking for pictures of it. I couldn't find anything. This thing's super secret. I want to see this thing.
There is very little information about the spending as well. We heard 100 billions from the president, but there has been other figures that have been out there. So it's really hard to tell exactly what's the plan.
All right, so let's talk about some other decliners. FedEx was certainly front and center. We talked about it throughout our broadcasts as well. You have to talk about it. It's such a good company to watch, a great economic bellwether.
Exactly, bellwether. We have weakening consumer affecting them, and we have the trade war really affecting them. And all those words people are so worried about, like inflation, consumer, it's clearly a really good gauge of this. That said, it started the day down about 12%. Those losses were paired to about 6%, so there was some relief there. Obviously, the market moved higher as well, so that was part of it. But the big negative reaction came after the company lowered its full-year guidance for a third consecutive quarter, and it cited inflation, which obviously market participants are very, very worried about. The company has big exposure to a lot of things in the global economy. You can imagine with the trade war ongoing and escalating, things get very complicated. And something interesting in their outlook is said that in their current outlook, they assume that things don't change, don't worsen. So you can imagine if things escalate from here, maybe we can see more pain for the company, which is already down 18% year to date.
Okay. Let's talk a little bit about some retail.
Yeah,
I want to talk. Yeah, go ahead.
Staying on the consumer.
Yeah.
Nike. Again, something that we're worried about the growing trade war. That was something that was mentioned. And we have this big turnover in Nike that has been happening for some times. Nike shares ended the day 5% lower, thanks to a subdued outlook with their third quarter results. Year-to-date losses are 10%. That said, there was a lot of optimism. We talked about it quite a few times in these few weeks. They had the Skims campaign, they had the Super Bowl ad. So there was like a lot of upgrades and people were quite positive on the stock. So there is some underlying optimism, but clearly the weak consumer backdrop, the tariffs are putting pressure on yet another retail name.
Yeah, I keep thinking about that Super Bowl ad, right? All women. And I do think about, we were talking with our Kim Basine about, is Nike still relevant? And it seems like their new CEO is out there talking to sports, to well-known athletes and thinking about, I guess, how they're using different, products from them and how to leverage it. So, you can't, count them out yet.
Yeah, I'm kind of excited about the new collection. I'm really spent all my money on gym clothes, so I'm excited.
The Skims collection?
Yeah.
I mean, if you think about it, right, that partnership, maybe what they can do with it could be pretty cool. I think what's interesting, too, is that a lot of these names that you just talked about, you mentioned Nike, it was down 9% at its lows, but finished well off that worst level. Same thing for FedEx. So we did see that happen maybe in the trade, right, a bounce off the lows for a lot of names today.
For sure, which is good news.
It is good news. It's a great way to kind of wrap up on this Friday. Thank you so much. Bloomberg News cross-asset reporter Denitsa Sikova on Friday's Stock Movers. And that is almost going to do it for me and Tim Stenovec. Tim, you have had quite a week.
Yeah, it's been great being out here in San Francisco, keeping the seat warm for Ed Ludlow and Caroline Hyde on Bloomberg Technology a little earlier. Ed's going to be back in a few weeks after his parental leave. Caroline's back next week, I believe, after a quick trip across the pond. Matt Miller is in for Caroline on Monday on Bloomberg Technology.